Hey, hello, and welcome to those who've just joined us. Great to have you here in the session. We were just giving everyone a moment to join us, but I see we have a good number of attendees now. So, in the interest of time, let's get started. A big welcome to this half day of training on applying the IFRS Sustainability Disclosure Standards. I'm Fiona Quinlan Wells from the UN Sustainable Stock Exchanges team, and it's a pleasure to be here with you all today. Firstly, a big thank you to all of you as participants for taking the time out of your day to join us in this training session. We appreciate there's a lot to cover in this training and it's a good proportion of your day. So we appreciate you dedicating that time to this topic. And a big thank you as well to all of our partners who helped to make this program possible. So, firstly, to the IFRS Foundation and to the IFC as well, and our supporters at the Swiss government as well. And of course, today in particular, our thanks go to the Colombo Stock Exchange for hosting today's workshop with us. And with that, I'm very pleased to introduce the CEO of the Colombo Stock Exchange, Rajiva Bandaranekar, who's joining us here today as well to provide our welcome remarks. So big thank you to you, Rajiva, and the floor is yours.
Thank you and good afternoon, everyone. It's my pleasure to very warmly welcome all of you today to this special training workshop hosted in partnership with the UN Sustainable Stock Exchange Initiative, the IFC, and as you heard, the IFRS Foundation. So at the outset, I would like to thank all of you for your attendance and of course the UNSSC, the IFC and IFRS Foundation for coming together to organize today's workshop. I believe that your presence here underpins the collaboration between Sri Lanka's corporate world and international facilitators of sustainable business as we all strive towards a responsible greener economy. As you know, the IFRS Sustainability Disclosure Standard is comprised of IFRS S1 and S2 and was issued by the ISSB in June 2023, marking somewhat of a landmark moment in corporate reporting. Sri Lanka was a member of the first batch of 17 jurisdictions to adopt the ISSB standards by issuing a localized version of these standards, designated as SLFRS1 and SLFRS S2, which are effective from the 1st of January in 2025. The phased adoption of the ISSB standards between 2025 and 2030 will ensure inclusiveness as it tailors requirements based, of course, on the size of the business. In 2025, the first 100 listed entities on the CSC based on the market capitalization as of January 1st, 2025 were mandatorily required to comply with the new sustainability standards. With this requirement being extended to all listed entities on the main board of the CSC beginning on or after 1st January 2026, that's this year. By 2027, all listed entities on the CSC, except those listed on our Empower board, which is the SME board, will be required to comply with the standards for financial years beginning on or after 1st January 2027. These standards establish a common language for sustainability-related financial disclosures, enabling investors, regulators, and other stakeholders to make better informed decisions. Through the IFRS S1 and S2, we can establish clear requirements for companies to identify, measure, and communicate sustainability-related risks and opportunities. The IFRS S1 and S2 standards aim to close the information gap between companies on one hand and the capital market. In doing so, we can enable greater direct investment towards more resilient and sustainable enterprises. The adoption of IFRS Sustainability Disclosure Standard notwithstanding, the CSC, in collaboration with its partners, has over the past few years successfully integrated, introduced, and upheld a culture of sustainable finance in the Sri Lankan capital market, setting new investor expectations and, of course, issuer standards as well. Since the 2024 GSS Plus bond framework was introduced, up to about 82 billion rupees have been raised. In 2025, 40% of the debt capital that was raised through green, blue, social, and sustainability linked instruments, funding things like renewable energy, efficiency, resilience, and social infrastructure. This year, it's pertinent to note that DSCC, BOC, and Commercial Bank were recognized for their initiative and innovative GSS Plus bonds at the Environmental Finance Sustainable Debt Awards in 2026. So today's workshop will equip you to confidently adopt the ISSB standards, understand the requirements, and begin implementation. It will provide practical step-by-step guidance to navigate disclosure changes, identify financial risks and opportunities, strengthen governance, strategy, and risk processes, and effectively communicate organizational resilience to climate and sustainability factors in a, of course, global context. Through the collective effort of all those who are in attendance this afternoon, we shall be able to shape a rising industry standard for sustainable financing in Sri Lanka and drive Sri Lanka and our economy towards a green future. So today's workshop is the next step in our journey to build the knowledge and the capacity across our market to go further together. So with that, I will close, and I wish every one of you and those who are presenting a very productive and enriching session. Thank you.
Thanks so much, Rajiva. Fantastic to hear as well about all the great progress already being made in Sri Lanka. So many congratulations to your market already for taking such important steps on this topic that give us a good base to build from in today's conversation, no doubt. So many thanks again.
Thank you.
Fantastic. So I'm also pleased today that we're joined by our colleague Alopa Rahman, who is ESG officer. So she leads on corporate governance advisory for the South Asia region at the IFC, which is part of the World Bank Group and one of our partners on this training program. So big thank you also for joining us, Alopa, and I'll pass over to you to say a few words as well.
Thanks so much, Fiona, for organizing this, and many thanks to the Colombo Stock Exchange, and very happy to see Rajiva delivering opening remarks. The Colombo Stock Exchange has been a long-standing partner for IFC in its corporate governance work as well. So I'm really pleased to see that this training has taken shape. For our advisory work, we've been providing technical assistance to, and me personally, in jurisdictions in South Asia. So worked with Bangladesh and as well as Nepal in helping adopt IFRS S1 and S2. And we have been also providing example from Sri Lanka's jurisdictional pathway on the adoption. So the example that Rajiva mentioned on how the companies are to take this forward. And for example, for scope 3, there is some transition relief provided if it's material to companies. So these are some of the examples that we also share with our other countries in the region to help them shape their jurisdictional pathway. So for us, this is a very important work that promotes our corporate governance mission. Within the IFC's corporate governance unit, strengthening governance, transparency, and accountability is a key work. And we do this through the Beyond the Balance Sheet program as well, supported by our global team that helps with providing us with toolkits and helping companies really, handhold and really help them in implementing how their disclosure pathway, so how they should be adopting these standards in order to write out their sustainability reporting, providing investor useful information that is reader friendly. So we've been doing a number of capacity building and training as well in person for Bangladesh as well as Nepal. So if there are companies in Sri Lanka that would like to avail some of our in-person or advisory support, please do reach out to me and we are available. We'd love to hear back from you. And back to you, Fiona, for a wonderful session. And, lovely to see you back again. Thank you.
Thanks very much, Lopa, and the same to you, of course, and great to hear about all the fantastic work that you're able to offer to support companies in the region. So definitely encourage all of our attendees to take advantage of that opportunity as well. Fantastic. Thank you so much. So, with that, I'm going to just cover a few practical points before we get started on the content for today's session. So, just a few housekeeping points. So, firstly, just to say, as participants, you muted in today's session, but that doesn't mean that we don't really want you to collaborate and participate actively in the session. So, great to see a number of you already sharing your comments in the chat. Feel free to share any general comments or to introduce yourself in the chat as we go through the session. And then the second tool that you'll want to make use of is the Q&A box. So if you have particular questions for the team, we'd love to hear those, but make sure to put them into the Q&A box because that will just allow us to directly answer your question and make sure we don't lose them in the chat anywhere. And then as well, a few more practical points. So we've got a live 3.5 hour session today. We will take a break in the middle of that session. There's an optional homework assignment that you can take away to complete after the training, which we'll tell you more about later. As I've mentioned already, do make sure you make the use of that opportunity to ask your questions today. We've got a number of technical specialists on our training today who I'll introduce to you shortly, and they're available to answer your questions. So do make the most of that opportunity. As I've already said, we really do encourage your participation in the training. We're going to be using a number of features, including a tool called Mentimeter, which we'll tell you about shortly. So it'd be great to have your participation in those exercises. And then finally, if you take part in our full workshop today, you'll be able to receive a completion certificate. To get your certificate, you'll need to fill out the feedback survey that we'll share with you at the end of the training. So be sure to keep an eye out for that, instructions for that when we get to the end of the workshop. So to introduce who's covering the training for you today, I've already introduced myself. I'm Fiona, and I'm joined today by my colleague Lois from the SSE team. Hi, Lois. And alongside us as well, we're very pleased to be joined by our partners in the IFRS Foundation's capacity building team. Thanks to Robert and Bella for joining us today as well. Hi to you both. So from our session today, we have 3 key learning objectives that we'd like to help you work on. So firstly, we hope you'll come away with understanding the ISSB standards, the fundamentals of what they are. Secondly, we'd like to focus on understanding how to use the ISSB standards, so how to really put them into practice. And then finally, building on that, we'd like to help you to identify how to develop your organization's own disclosure plan to really apply the standards for your organization in the right way. And so to help us achieve that agenda, we've broken our session down today into a number of modules, which you'll see represented in this sort of wheel diagram that we've got on the screen now. So you'll see that diagram popping up throughout the session, and that will help you to just keep track on where we are in the session. So we'll start in the top left on our prepare module, thinking all around what the case for sustainability reporting is and how the reporting landscape has evolved until the present day. We'll then move into align, which is thinking all around how to set the particular direction for your company's reporting to particularly apply and use the IFRS S1 and S standards, and how to do so in parallel with other additional disclosure requirements you may have. We'll then move into implement, which is all around the practices and systems that you need to identify, evaluate, and integrate sustainability risks and opportunities into your organizations and into your disclosures. And then finally, we'll finish off with communicate, which is all around the final format of your reporting. Thinking about this, you really want to think about how to do so in a way that is efficient and that builds user confidence. That's what we'll focus on in that module. And just to show you that in another way, here's our agenda for the workshop. We split the time reasonably evenly across our modules, maybe spending a little bit more on our second module, which walks you through the standards. We'll take that break in the middle as well, as we say there, and then wrap up at the end with some additional resources for you. So an important thing to make sure everyone's aware of is that you're able to access the training materials from today's session already from the SSE webpage. So we'll share this link with you in the chat. Thanks, Lois. If you follow that link at the bottom of the page, you'll be able to find the slide presentation that I'm sharing with you now, as well as the homework assignment that we'll talk to you about as well. In the slides, you'll be able to find links to all of the resources we're discussing today and some of the things that we share with you in the chat. So be sure to take a look at the slides directly if you'd like to follow along. We also include some supplementary slides there with some extra detail in certain areas, which we'll tell you about as we move through the session. We'll add the recording from today's workshop onto that page as well after we finish the training. And as I've already mentioned, there is an optional follow-on activity you can do after our workshop today. There's a homework assignment that you can download from that same page that we've shared in the chat at the bottom of the page. And this is designed to help you develop your own organization's disclosure plan to put into practice what we're talking about today. So it's not mandatory to do the homework and you don't have to submit it to us in any way, but we hope this can help you to start taking forward conversations internally after the workshop. And another key suite of resources just to mention is the SSE Toolkit. You can find the link to download these from the slide handout, or if you go to the SSE website under publications, you'll find them there. And thanks, Lewis, for sharing that link in the chat. But a number of resources we've developed here to support you on this topic, which I'd recommend taking a look at. But as we're getting started, we'd like to just do our first Menti question with you all to check where you're at with your current understanding of the topics we're going to be talking to you about today. So we'll come back to Menti a couple of times during the training session. So it's a good opportunity now to find your way into Menti, and then we'll use that same link that we'll share with you shortly throughout the training. So the link should just come up shortly for you in the chat. If Lois, you would be able to share that, thanks so much. So if you click that Menti link that you see in the chat there, that will take you directly to this question. Another option that you have, I'll just put it up on the screen, is to use that QR code and join us from your phone. And you can also finally go to menti.com and enter that 8-number code that you can see on the right-hand side of the screen and also on the top of the screen as well. But the first question for you is just to tell us in your own words why you've joined us in today's training, maybe what you're particularly interested to know about, maybe what your driver is for being interested in this topic, any word that comes to mind, really. Okay, so I'm seeing requirements, learning, application, knowledge. So maybe a little bit of difference already. Some people here because they have to be, and some people here maybe to optionally build their understanding. We understand both perspectives, of course, are important. So let's see, we've got learning about reporting, improving knowledge, more people mentioning knowledge and application. So hopefully we'll be able to support you today in really getting into that. Implementation, I see. Fantastic. Loads of great words. And it looks like lots of you were able to join us in Menti, which was also the first thing we wanted to test. So great. Thanks for letting us know that. Understanding market requirement, I see in the chat as well. Thanks, everyone. If you are able to join us in Menti, please do, because we'll be using it for a number of exercises as well. But obviously, if you can't access Menti for any reason, the chat's a good idea as well. Okay, so one more question just to warm us up together is to get a sense of how comfortable you are with your current understanding on a number of the areas we're going to be talking about today. So how comfortable would you be currently with explaining to your team what the ISSB is, in using the ISSB standards, and in developing a sustainability reporting strategy? So you can use that sliding scale that you'll have in Menti there to let us know from maybe a complete beginner on the left-hand side and not very comfortable to maybe you're already working quite a lot on this topic and you know it very well on the right-hand side. Let us know where you think your current understanding is at. Always useful for us just to get an understanding of this and also to see if we can help you improve that in the session, of course, as well. So from responses so far, it looks like most of us are sort of between 2 and 3 out of 5 on the scale with our understanding at the moment. No problem, of course. That's a good base, I think, to come into today with. And for those of you right at the beginning of this as well, not to worry. Hopefully, today's session will help to shed a little bit of light on this topic for you. Great, thanks everyone for sharing those things in Menti. So I'd recommend keeping that tab open in the background. We'll come back to that link later. But I'll just take us back to the slide presentation now, and we'll get started on our first unit of the training. So before we dive into the content, a quick disclaimer to share with you. And this is just to be clear about how we're going to be using examples in today's training. We use particular company disclosure examples because we know it's helpful to see some real life examples of how companies are approaching this. But we'd just like to be clear that any examples we share shouldn't be seen as the best or necessarily the right way to report. We need to remember, of course, that each company's circumstances are unique, and so you need to disclose in the way that's right for your context. But hopefully those examples can offer some inspiration to help you get started. So with that established, let's move on now to starting our prepare module. And in prepare, we're really looking to build that solid foundation of knowledge that we can move forward with in the rest of the training. So here we'll cover three key areas. So we'll start with purpose, which is all around what the purpose of sustainability reporting is and what the market drivers are that are leading to more organizations focusing on this topic. We'll then move into landscape. So that's thinking about how the reporting landscape has evolved, the different standards that have developed over time that have moved towards this global baseline of the ISSB. And that's where we'll finish this module with is the global baseline. So we'll introduce at a high level the core requirements and concepts that sit within the IFRS S1 and S2 standards. Great, so let's get started with our section on purpose then. And so our first starting point here is really just to get a sense from all of you as to what your particular drivers are for focusing on sustainability disclosures. So I've popped a poll up for you there, which hopefully should appear in your window now. And you can let us know by selecting one or more options here what your main reasons are for disclosing or being interested today in thinking about disclosure on sustainability related information. Whilst you're responding to that, I can see we've got a few raised hands. Unfortunately, we're not able to take live questions, but encourage you, if you do have any questions for the team, to place those into the Q&A box and we'll get back to you there as well. Great, thanks everyone for responding to the poll. I'll give you a few more seconds and then we'll have a look at the answers as well together. Okay. Thanks, everyone. Let's close the poll there and I'll share the results. So it looks like the winner today was definitely regulatory requirements, with 81% of you identifying that as a key reason. Of course, that's very logical from what we've heard already from our colleagues at CSE regarding the developments in your market. I see investor interest, though, is a close second. Lots of you mentioning that as a driver, so that's great to understand as well. Thanks, everyone, for responding to us there. Okay, so moving in then to have a look at some of these drivers. So a lot of you did mention investors there. And we think this is a good starting point today because it's really the primary audience that the IFRS disclosure standards have been designed to support. So you'll see here some data from the Principles for Responsible Investment, which is a UN initiative that investors can sign up to. And you'll see that we've seen a growth in recent years of the number of investors who are signing up to these responsible business principles. And so why do we think it is that investors are increasingly focused and interested on topics of sustainability and responsibility? Well, I think what we'd really like to highlight here is that we think a key driver behind this demand is the potential financial effects of sustainability related issues for investors. And really that growing recognition from them that companies need to be considering these factors as part of their consideration for long-term value creation and their strategic resilience. So the data that you see on the screen here comes from a survey of institutional investors that was conducted last year by HSBC. And this showed that the top driver for investors to incorporate climate change and environmental issues into their investment strategies from the survey respondents was the perceived impact of these factors on long-term performance. So I think really just want to be clear here that investors are no longer seeing sustainability as something from just an impact lens or a nice to have, but really a core element of how they're considering companies and their performance. And when we're moving on to talk about performance, let's see if we can be clear on a few key terms today. So it's important to remember that we're going to be talking today about disclosing financially material sustainability related information. So we'll go into more later in the session about what we mean by material information. But let's be clear from the start about the sorts of financial effects that investors would be looking to have more information on. So if we start with effects on a company's financial performance, we often see this reflected in the statement of profit or loss. And so sustainability related risks and opportunities may have a financial effect for companies, for example, by changing the revenue mix or total revenue of an organization. This could be perhaps if there was a change in demand for its products and services, or maybe if it needed to invest more in R&D to manage sustainability risks or capitalize on opportunities. Which could lead to changes in expenditure as well, as you see there too. So the second element here are also effects on a company's financial position. So we see this reflected in a company's balance sheet. And so here, for example, there could be potential for changes to certain assets or liabilities due to climate or sustainability issues. For example, we could see changes to portfolio value or even write-offs of certain assets which are damaged as a result of climate or sustainability risks. And we could also see changes to financing and the cost of capital. For example, we could see changes to equity valuations that are impacted by climate risks, or we could also see opportunities in relation to making use of new financial structures such as green bonds or social bonds. And as we're finishing off this unit, just a few key things to highlight relating to risks and opportunities. So before we jump in, it's worth noting that when we get into the standards themselves, they're really designed to help a company identify its own specific sustainability related risks and opportunities. But if we start firstly by looking at the global picture, this can help us to understand a few key points. Firstly, one key thing to say is that risks can evolve over time. So you'll see here data from the World Economic Forum's Global Risks Report, which you may be familiar with, which shows that actually those risks that are front of mind for business leaders in the next 2 years are quite different from those that they expect to be most significant over a 10-year timeframe. And so this is important for disclosure because actually, if we're taking steps now to prepare for those longer term risks, it may be that we need to take mitigation actions or investment decisions today to realize those opportunities or to manage the risks. And what that could mean is that we actually see those financial effects occurring earlier than the risk itself. Those financial effects could also change over time. So that's something we really need to keep in mind as we're disclosing and preparing our information here, is the time horizon element of our disclosures. And a second key thing to highlight is the interconnectivity across sustainability topics as well. So this is another diagram from that same report, and it really just shows how interconnected ESG topics are and how interconnected they are with other business-related issues as well. And so all of this is just to say that although we might have individual topic standards, such as the IFRS S2 topic on climate change, in practice, of course, these issues are very interconnected. And so as much as we can within our disclosures, we need to be thinking about that interconnection. And this is where the IFRS S1 standard, which we'll go through shortly, is also very helpful because it sets out some of the conceptual foundations for disclosure, including how to report connected information, really with that aim to give investors a holistic picture of how we're approaching these topics. Fantastic. So that brings us to the end of our first section, and I'll pass you over to Lois now, who'll get us started on landscape.
Thank you, Fiona, and hello, everyone. Well, Fiona's explained to us why the sustainability reporting standards are important, so we're now going to look at how they have been developed. Before we do that, may we ask you, what standards or frameworks are you currently using to prepare your sustainability disclosures? Are you already using IFRS S1 and S2? Are you reporting against the Global Reporting Initiative standards, the Integrated Reporting Framework, the standards set by the Sustainability Accounting Standards Board, the recommendations of the Task Force on Climate-Related Financial Disclosures, or regional standards, or others? And if there are others, please tell us about them, what they are in the chat. Thank you so many of you for participating. This is great. Yes, some of you using FRS, as we heard described at the beginning of the program. Let's share the results now. So you'll see, yes, the majority of you already using S1 and S2, or the local version, followed by GRI and integrated reporting. So quite a mix, and some of you not using anything yet. So hopefully this session will help you. But good to see so many of you already using S1 and S2. Let's go on then with our training. We're going to look now at the structure of the IFRS Foundation, which is the body that that created the ISSB standards we're looking at today. The IFRS Foundation is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting and disclosure standards. The IFRS Foundation hosts two independent standard setting boards. You can see them at the bottom of the screen. The International Accounting Standards Board, or IASB, was formed in 2001, and their financial reporting standards are in place in over 160 jurisdictions around the world. The International Sustainability Standards Board, or ISSB, formed in 2021 and released its first two standards, IFRS S1 and S2, in 2023, following strong market demand for the establishment of the ISSB and its standards. Because they're both within the IFRS Foundation, the two standard setting boards work closely together to ensure that their standards complement each other. Governance of these standard setting bodies is provided by trustees, and they in turn are accountable to a monitoring board of public authorities. So how did these standards evolve? Well, lots of logos on the screen here, some of which I'm sure you recognize. And these are the logos of organizations that have all contributed to the evolution of sustainability reporting. Most of the organizations here focus on meeting investor needs for sustainability information, except for GRI, which supports a broader range of stakeholders. Now, the arrows you see on the screen show us that some of the organizations have been consolidated into, or their work has been incorporated into, the IFRS standards. So, for example, the TCFD recommendations, some of you will be familiar with, they form the basis for the ISSB standards. The TCFD's work has now culminated and it's disbanded, but its work is represented in the ISSB's work. Similarly, the disclosure-specific work of the Transition Plan Task Force is now the responsibility of the IFRS Foundation. The integrated reporting framework, the standards of the Sustainability Accounting Standards Board and the Climate Disclosure Standards Board have all been consolidated into the IFRS Foundation's work. CDP has aligned its questionnaire on climate with IFRS S2, and GRI and the IFRS Foundation work closely together to ensure that their work is aligned as much as possible. So one message to take from this slide, it is a picture of harmonization and simplification. And we expect this to continue as sustainability disclosure develops. So let's see how you would answer this question. You can select all that apply. So the Zoom poll asks you if differences between reporting standards and frameworks still exist. Is this due to differences in reporting objectives, the scope of reporting, definitions or wording, the materiality focus of the organisation, or something else? And if something else, let us know in the chat. Just give you a moment more to think about this. share the results with you in the interests of time. Sorry, we don't give you too long to answer these. Yes, all of these apply, really. All of these reasons can explain differences between different reporting frameworks and standards. But you're right. I mean, the main reasons are differences in reporting objectives and scope, and indeed reporting objectives for different audiences. So the GRI, for example, focusing on the needs of a wide group of stakeholders, and ISSB focusing on investor information needs. Scope can differ in terms of the subjects covered or the type of companies within scope. So yes, you're quite right. All of these reasons can explain differences in frameworks and standards. So I won't go into this in detail, I mentioned that the TCFD's work has been incorporated into the ISSB's standards, and the IFRS Foundation now has responsibility for monitoring climate disclosure progress. So the main differences for the main reason for any remaining differences between TCFD and S2 is that S2 uses different wording to capture the same information. S2 requires more detailed information than the TCFD in some cases, for example, how carbon credits are used to satisfy greenhouse gas emission reduction targets, and S2 provides some additional requirements and guidance, and in particular, what we'll come on to look at is the sector-specific information requirements, and Fiona's provided you a link to the mapping document that you see on the screen if you would like further information about that. So the ISSB's objective was to set a global baseline for sustainability-related financial information, and that global baseline provides a common language for sustainability disclosure, and it enables comparable and consistent sustainability disclosures across global capital markets. And the Foundation is working with jurisdictions around the world, as well as other stakeholders, to achieve this common language. So what would happen if regulators or stock exchanges in particular jurisdictions wanted to ask companies to provide information in addition to what is in the global baseline in the standards? Well, they can do that by adding building blocks of information requirements tailored to their own needs. For example, stock exchange guidance on disclosures. So those additional disclosures can be required as long as the information is presented in a way that does not obscure the disclosures required by the ISSB standards. So these building blocks could involve disclosures that go beyond the remit of the ISSB. So they could include the type of information GRI asks for, or they could include jurisdiction-specific information relevant to investors. So this building block approach reduces the need to duplicate information by having a globally consistent baseline of disclosures for capital markets, while still allowing you to report additional information for particular jurisdictions or wide stakeholder information needs. There's global backing for this approach, the approach represented by the standards, which represent the baseline. The International Organization of Securities Commissions endorses the ISSB standards and has asked their 130 members to consider how they could incorporate the ISSB standards into their regulatory frameworks. The International Auditing and Assurance Standards Board has issued an assurance standard for sustainability information, ISSA 5000, and this supports sustainability reporting veracity. As I said before, the ISSB is working with jurisdictions around the world for adoption of the standards and also for voluntary adoption. So we're going to hand over to our colleague Bella now from the ISSB, and she's going to start to explain the standards to us in more detail. Over to you, Bella.
Thank you so much, Lois. Yes, let's continue with the standard. Yeah, we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. As we start, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can be information about a broad set of issues, including climate, nature or biodiversity, human, social, or others. Sustainability-related financial information is information about a company's sustainability-related risks and opportunities. That is useful to investors in making decisions about providing resources to the company. And the sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and the management commentary. You may know this as a management report, management review, management discussion and analysis, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Here we have just summarized the key points of each term, but you can also refer to S1 for fuller definition of each of these phrases. Yes, for anyone familiar with TCFD, will recognize the same 4 core pillars or content areas for the SSB standards. These are governance, strategy, risk management, and metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, and I encourage you to download the standards as part of your homework assignment. Okay, for all the preparers listening, let me start by saying don't be afraid. Yes, there is a lot to understand, but you might be surprised that some of the detail is familiar. And for all the accountants listening, you too will be relieved to see many of the conceptual foundations developed by the IASB in the ISSB standards. So now let's start with S1, or give it its full title, General Requirements for Disclosure of Sustainability-Related Financial Information. S1 sets out general requirements for the content and the presentation of material information about sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied through all the standards. For matters other than climate, S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities, and identify material information about them. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunction with any accounting requirements. The scope of S1 is all sustainability-related risks and opportunities. And the second standard, S2, focuses on climate disclosures, building on the same foundation of S1. For example, it fully incorporates the recommendations of TCFD, and it sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And it also requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2, such as the SASB standards. These are organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. It's really important to know that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Next, let's consider some of the conceptual foundations that underpin the SSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the SSB standards. So first, companies must fairly present a complete set of sustainability-related risks and opportunities. Fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The SSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between disclosures in the four content areas, and connections between sustainability-related financial disclosures and the main financial statements. So, after introduce a lot of regarding the standards, it's time for an example. So over to you, Lois, to go through this example.
Thank you, Bella. And as this is our first example today, I just want to remind you of the disclaimer that Fiona gave at the beginning of the session today, that we show you examples as inspiration and illustration. They're not intended to represent best practice or good practice. They're just to inspire you. So this example is about connectivity. It's from BHP's 2024 annual report, and BHP is a global mining company. And this part of the disclosure explains how BHP manages climate-related risks and how it plans to transition to a net zero economy. The extract describes the impact of the company's climate-related risk assessment and climate scenario on the business and capital allocation plans. It shows the connections between the company's decarbonisation strategy and its financial results and other processes. So the company has undertaken climate-related risk assessment and climate scenario analysis. And they look at and they integrate the results of those assessments into the company's strategy, and they treat them as a sensitivity in their capital allocation process. So connections and alignment between the company's capital allocation plans and the rapidly decarbonising global economy are considered. Now, in the middle paragraph, they tell us that some assessments are still in progress, particularly on future physical climate-related risks. But they are going to use the results of that to understand how those physical risks could affect the company's operations, risk profile, productivities, corporate planning, controls, and adaptation measures. So they intend to connect those results to other parts of their business in due course. The light grey text at the bottom tells us where we can find further information about the effects of climate change on different parts of the business's processes, including on operations, risk control, and finance. So back to you, Bella, for a Zoom poll.
Thank you, Lois. Yes, you are right. It's time for a Zoom poll. Yes, the question is what information should be considered for connected information? Is it connections between governance, strategy, risk management, and metrics and targets? Or connections between sustainability-related financial disclosures and financial statements? Or connections between sustainability-related risks and opportunities? Yes. We covered these connections and in the conceptual foundations before the sample. So let's just wait for a few more seconds. Okay, so I'm going to end the Zoom poll and share the results. Well, yes, well done. I think most of you have chosen the correct answer. The correct answer is all of them are correct. And there are three aspects regarding connecting information or connectivity. That's connections between four content areas, connections between sustainability-related financial disclosures and financial statements, and also connections between sustainability-related risks and opportunities. Okay, so let's continue with the slides. Yes, the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. During the SSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The SASB standards were used to create the industry-based guidance accompanying S2. And the FIC credential was also updated with more planned to come. I should also note that the IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, so let's do another Zoom poll. Yeah. Water is a vital input to a business, but the SSB standards do not currently have a specific standard on water. What do you do? Is it do not disclose anything about water or consult the sources of guidance listed by SSB or engage a consultancy to help or copy your competitors' reporting? Okay, so let's wait for 2 seconds. I'm going to end the Zoom poll and share the results now. Okay. So the winner is option B, consult the sources of guidance listed by SSB, which was chosen by 77% of all participants. So well done. This is the correct answer. Yes, although our SSB standard hasn't yet issued a topic-specific standard except for climate, this doesn't mean companies ignore the issue if it is a material. Instead, the standards allow and expect companies to look to other relevant sources of guidance, for example, CDSB water guidance, including industry standards and frameworks, to identify and disclose material sustainability-related risks and opportunities. So option B is the only correct answer, and option A is not correct because water is a vital input, which means water-related information should be the material information for your sustainability disclosures. And sometimes you may find engage in consultancy to help and copy your competitors' reporting is easy way and also helpful. But for this question, option B is the correct answer. Okay, so it's time for Fiona to the module 1 summary. Over to you, Fiona.
Great, thanks so much for that, Bella. So as we say, that brings us to the end of our first module. So we'll take a few minutes now just to wrap up on the key points we covered before we go back to Menti for a bit of an activity. So firstly, we reviewed in this section the purpose of sustainability-related disclosures. And really a key takeaway that we're hoping that you'll leave this workshop with is the understanding that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. So ultimately, if you're not aiming to make good use of that data that you've collected for disclosure purposes to inform your own strategic decision making, you're really missing an opportunity. And as well, if you potentially are in a high impact sector or you have difficult to abate activities, it's quite likely that your competitors are already starting to disclose and manage risks and opportunities that they're pursuing. And then in time, that's going to leave your investors wondering why you're not perhaps identifying and managing the same issues. And as we heard, that could start to affect your equity valuations or your access to capital. So better to get ahead of that as well. And then we also looked at the evolution of disclosure standards and that formation of the ISSB with that aim to simplify the landscape. And so when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And then finally, we introduced the standards themselves and the key concepts that you need to understand in order to use them correctly. And I think a key point that I'd like to highlight here is that the standards are really designed to meet the needs of investors. And so they're heavily focused on the prospects that we discussed at the start of the unit relating to effects on financial performance and financial position. So something to keep in mind. And I see Adnan commented here to say water isn't included. I think you might be referring back to the last poll question. That's quite a key concept, actually. So let's just revisit that quickly. So as we said with the poll, even where the ISSB hasn't yet issued a topic-specific standard, doesn't mean that companies should ignore that issue if the information about it is material. Instead, the standards allow you to use other relevant sources of guidance. For example, here you could use the CDSB's water-related disclosure guidance to help you to identify and disclose any material sustainability-related risks and opportunities. So that's just an important point to get clear on, is even if there aren't individual topic standards for every issue, the IFRS materials have been designed in a way to help you to use them to identify and disclose on a wide range of material information. Okay, so just to go back now to our Menti for another quick question activity. So I've shared the link in the chat. I'll just share it again so it's the latest message for anyone who needs it. And you can go to that page. But just to set up what we're going to be reflecting on, in the exercises at the end of each segment, we're helping to think about the ideas that you would need to build your organization's disclosure plan. This will just be the initial thinking, and then you can take those ideas forward in the homework exercise if you'd like to. And what we think is really good to be clear on at the start of your disclosure plan is what the objectives are for your sustainability reporting. And so you might think, firstly, that your objective is just to comply with a regulatory requirement, for example. But actually, what we think is really important is to identify early on some of the other. Oh, I think the slides are moving. If I could just ask my colleagues to be careful there. I'll take you back a little. Here we go. The possible kind of areas that you would want to focus on when you're setting your objectives would be to think about particularly what are the reporting requirements that you're seeking to align with, but also what perhaps is the rate of change that you need to make. So if you have no reporting in place at the moment, you might have a lot of work to do, of course, to implement an entire approach and start disclosing. So that would inform your objectives here to be quite ambitious. However, if you're maybe already somewhat established in sustainability disclosures, maybe instead your ambition here is just to iterate and to evolve your reporting over time to align with the particular aspects that you're missing. But as much as we can, I think it's important to also think about how we can maximize the benefits from reporting internally and externally at the same time. So let's go back to Menti and see what you guys had to say about this. So I can see we've already got some answers in, so I'll just share the screen so we can see those together. If you haven't had the chance to type yet, though, don't worry, we'll spend a minute or two on this, so still time to put your contribution in. Okay, let's make that a little bit bigger so I can see. There we go. Great, thanks everyone. So the question in Menti then was, what objectives are you aiming to achieve through your sustainability disclosures? So there's no right or wrong answer to this question, just an opportunity to reflect really on what do you think is the way that you would like to approach this for your organization, or perhaps organizations you're working with if you're advising them in some capacity. So we see performance improvement and regulatory compliance. So good to highlight both of those, actually using this information to improve efficiency, reduce costs, manage risks better, all possibilities indeed. Complying with mandatory reporting, mitigating regulatory risks, and ensuring full transparency with our stakeholders. So regulatory risks and transparency, two other key objectives there. Someone else is mentioning promote transparency, demonstrate responsible business practices, meet stakeholder expectations, and support continuous improvement. Yep, that's great. I see a few more mentions of compliance, transparency, improving investor focus. I think maybe are you thinking about that through the lens of actually either making your reporting more focused on what your investors want to know, or maybe you want to actually get your investors more focused on these issues. Both, I think, are important things to potentially be able to achieve through this. Someone's mentioning long-term market resilience, building investor trust. I think all good points. Great. Attracting investment, absolutely. Supports progress towards sustainability and climate goals. Yeah, so being able to demonstrate that you're on the right track with those, and that you're well placed to kind of support those long-term achievements is going to be positioning your business best, I think, for long-term value creation indeed. Presenting comparable, decision useful information to help your primary users, your investors, understand material risks and opportunities. Great. So indeed, lots of great thoughts here. Thanks everyone for sharing these. Showcasing stakeholders our commitments. Yeah, and I think that's what's really key here is using this structure to not just set a top line objective, but actually to demonstrate the action that you're taking, how it really feeds through across your organization as well. So I think that's what's great here is that balance it can give you. Aligning with disclosure requirements and aligning the organization towards net zero as well. So maybe in particular, the climate kind of side of disclosure is of interest for you. Perhaps that would mean focusing on the sort of climate first approach that's a possibility, which we'll hear more about. Let's have a look. Aligning with governance strategy and metrics. Attracting capital from development finance institutions as well. Indeed, as we heard from Lopa at the start, from the IFC perspective, these factors are really fundamental to their approach. So indeed, many DFIs are very much looking for this type of information from investees as well. Climate-related resilience too. Great. Lots of really good thoughts here. And I think shows well that you have grasped or already knew that message of how we can aim to maximize benefits from this. So, although, of course, complying with regulatory requirements is an important objective, I think you're really demonstrating here that there's a lot more that we can gain from disclosure internally and externally if we set out clearly at the outset with our colleagues what we could achieve. So I think that's what we think is really helpful in the disclosure plan, is to make those objectives clear with your colleagues so they really see the wider benefits that you can get from this as well as compliance. Great, thanks everyone for contributing there, really helpful. So we'll go back to the slides now, and Bella's going to get us started on module 2.
Thank you, Fiona. Oh, yes. Okay, let's continue. Yes. Well, now we have introduced the initial concepts. Let's dive into how to apply the SSB standards, taking into account additional disclosures, including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. In order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards as part of the global baseline for sustainability-related financial disclosures for capital markets. Once we cover that, we will also discuss how additional disclosures fit. To begin with, let's focus first on how to apply the SSB standards as the global baseline. Okay, so let's get started on the first core content area, governance. This aspect is centered on understanding how oversight for sustainability-related issues is providing in the organization through the processes, controls, and procedures that have been put in place at board and management level. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities. Is management responsibility delegated to the specific role or committee? And you can also ask internally how and when do they get informed about sustainability-related risks and opportunities, how these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And you can also ask whether progress against these targets links to executive remuneration. For more information, you can make use of the SSE checklist tool. But remember, it's not a replacement for reading and using the full SSB standards. So I think it's good for you to go through a few examples to see what we mean in practice. So over to you, Lois, for examples.
Thank you, Bella. Yes, we've got two examples of governance disclosures here. And of course, it is for companies to determine their own governance structure subject to any regulatory requirements. The first example is from a company called Yara, which is a global crop nutrition company, very big company headquartered in Norway. In this governance model example from Yara's sustainability statements in 2024, we can see that it has a highly integrated model, meaning that responsibility for sustainability is embedded across many different business functions, including risk management, health and safety, environment and quality, HR, global climate and energy, and others. In the dark brown boxes you see at the top in the middle, this is the board of directors and president and CEO. That's where they sit in this governance model. To their left, we see the Board Audit and Sustainability Committee, and that committee assists the Board of Directors in overseeing the process for and internal control of sustainability reporting and material impacts, risks, and opportunities. Below that, in the pale green boxes, right in the middle of the screen, you can see the Sustainability Governance Team. Now, they have a direct reporting line to the Chief Financial Officer, and the governance team are responsible for sustainability performance and reporting, but their work is closely aligned with the corporate performance and risk functions. At the very bottom, in the pale beige box, we see the Sustainability Network, and they review Yara's accountability processes and systems that are in place for ESG policies, and they monitor sustainability performance, and that network is chaired by the Chief Compliance Officer. The arrows that you can see indicate the flow of information and input between different governance bodies in the organization. So as I said, this is just one model, highly integrated, but your organization needs to choose the governance structure that is fit for your company, that suits its needs and is appropriate for the legal environment. Let's have another example here, and this is from Petronas, which is Malaysia's national oil and gas company and a global energy group with presence in over 100 countries. Again, we've got an integrated model here. The governance structure shows that these three bodies that form the executive and non-executive roles of board of directors, and three committees to which the board delegates authority, responsibility, and operations. So those three committees all have responsibility for sustainability and climate-related matters. So the audit committee, they monitor climate-related reporting, and they also provide assurance on the state of governance controls and compliance in relation to greenhouse gas emissions reporting. The Nomination and Remuneration Committee reviews the President and Group CEO's performance scorecard, which includes climate-related measures. And then at the end, we have the Risk Committee, and of course, their work includes climate-related risks and mitigations. At the bottom of the image, you see the executive leadership team, and their duties include sustainability too, and they report to and assist the board in their monitoring of sustainability issues. So in these integrated structures, you'll see that responsibility for climate and sustainability matters is embedded across multiple functions and not just one. And this type of structure gives clarity about people's roles and accountability. It promotes strategic alignment across the group and facilitates decision-making at all levels. So Fiona's going to take us through the strategy content area now.
Great. Thanks, Lois. So hopefully those examples have helped to make governance fairly clear to you. We'll move in now to looking at strategy. So there are more disclosures required within strategy than in governance, but it's also really where companies can start to see the benefits from managing sustainability-related risks and opportunities. And this content area focuses really on understanding what the company's strategy is for managing those risks and opportunities. And there are three high-level areas to focus on in this content area. And those are risks and opportunities, their effects, and then resilience. So we'll review each of those separately. So if we start with some of those questions to evaluate, IFRS S1 and S2 disclosure requirements here are really designed to enable the users of a general purpose financial report to understand that company's strategy for managing risks and opportunities. So if we're looking firstly at the requirements relating to what the risks and opportunities are, the starting point is to disclose or identify and then disclose the particular risks and opportunities that the company has identified that it feels could reasonably be expected to affect its prospects. And alongside that, the company is asked to describe the risks themselves, what the effects of the risks could be, the time horizons over which those effects are expected to occur as well. And this is where we also need to keep in mind that the financial effect could occur before a risk or opportunity materializes. They could occur after, or they could change over time, if you remember what we talked about at the start of the session. And then the last 2 points on this list in particular relate to climate regarding the disclosure of physical and transition risk types, which are the categories that drew from the work of the TCFD on climate risk. And both of the standards include guidance to support companies as they identify and disclose this material information about risks and opportunities. For example, by making use of industry-based guidance and the SASB standards. So let's have a look at an example of how one company has approached disclosing the summary of what its risks and opportunities are. So this example comes from Mondi Group's integrated report. Mondi is a packaging and paper company operating across Europe, North America, and Africa. So on the left-hand side here, we just see a simple summary of the company's principal risks, which you probably see within most annual reports. But this shows here which risks the company has identified and how those risks align with 4 key categories of risk type. So we have strategic, financial, operational, and compliance. And then they also identify the delegated owner for each risk. In the report, they then provide a more detailed description of what each of these risks is in the specific context of the company and what the effects of that risk could be. And then as they've identified climate change as one of their strategic risks, in the second extract on the right-hand side of the screen, we see a more detailed breakdown of the specific climate-related risks and opportunities that the company has identified and assessed. So we see both physical and transition risks and an opportunity section as well. Alongside kind of describing what the risks are, they then summarize here what they estimate the annual financial impacts of each risk or opportunity to be, the time horizons over which they expect that impact to be felt, and they've also analyzed how that could change under different scenarios, which we'll come into a little bit later in our examples again. So as we started to touch on there, another important aspect of the disclosure here on risks and opportunities is the time horizons over which those risks and opportunities are expected and when the particular effects of the risks and opportunities will be felt. So you might remember at the start when we talked about this, we explained that time can be a little bit different when we're thinking about sustainability disclosures. So the standards here ask you to identify within what time horizon the effects of each of those risks or opportunities could reasonably be expected to occur. How the company defines short, medium, and long-term time horizons is something that the company itself needs to determine, because this can really vary between companies, industries, etc. And so when defining those time horizons, factors to consider would be investment and business planning cycles, strategic planning horizons, the lifespan of assets, or other factors that may be relevant to your particular context. And so what's important really to remember here is that you do need to define and then disclose the particular time horizons that you're using, because without that, your investors won't necessarily know, because it could differ, of course, between companies. So moving on to the next group of disclosures in the strategy category. So firstly that was identifying what the risks or opportunities are that could be expected to potentially affect the company's prospects. And then the next set of disclosures is focused on exactly what the effect is of a risk or opportunity and where it would occur in the business. And so to start tackling the disclosure requirements here, companies would want to ask themselves questions such as describing what the effects are, understanding what responses they might have planned already to mitigate or adapt to the effects, and maybe any potential additional actions that they might want to take to improve that response in the future. So let's have a look at another example here. So this example comes from BASF's annual report. BASF is a chemicals company. And I think what's useful to highlight here is the approach that this example takes to explaining the effects of risks or opportunities on the company's business model and across its value chain. So it's always hard to do justice to a full disclosure in one visual. But this diagram just shows, I think, how they have outlined what their value chain is and the different aspects of what they call the green transformation that exist across their value chain, which shows, I think, really the different areas of risk and opportunity they've identified. So, for example, if they're looking upstream of their organization at their suppliers, they're focusing on the procurement of bio-based and renewable raw materials and how they better manage supplier relationships to reduce supply chain risk. Within their own operations, they're focused on kind of improving energy efficiency, reducing emissions, and improving the operational efficiency of their processes to reduce, exposure to emissions regulations, energy prices, and to improve their efficiency as well. And then finally, if they're looking downstream, they're focusing more so on what their customers want to see from them and the areas where they expect to see potential increases in demand for more sustainable products that they can kind of serve and adapt to. And in the commentary alongside this diagram, the company talks about the fact that it is aiming to achieve 10 billion euros in sales revenue by 2030 from transitioning to products that contribute to a circular economy. So, kind of illustrating the scale of transition the company is aiming to make here. And so we know that one of the obstacles that companies could face when they're disclosing on this topic would be the kind of type or level of detail to disclose and whether that needs to be quantitative or qualitative. So under the S1 and S2 standards, a company is required to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability-related risk opportunities. However, the standards do also set out criteria for when only qualitative information is required. And so using only qualitative information for current and anticipated financial effects is permitted if the company cannot separate the effects of a sustainability related risk or opportunity from other effects. So maybe there are other risk types which are also influencing the effects here. So it's not possible to isolate the particular climate or sustainability element of that risk. Secondly, if there's a high level of measurement uncertainty and it's just simply not possible to provide any sort of accurate estimate. And then finally, if the company itself doesn't have the skills, capabilities, or resources to provide that quantitative information. But overall, I think the takeaway here is if the company does have that quantitative information that it considers to be material, it's important that it does disclose that. So that brings us on now to the last part of the strategy component. So we've talked about identifying what the risks and opportunities are, describing their effects, and then the last part here looks at how the company is preparing for uncertainties and ensuring its resilience into the future. And so this really gets into the practices and processes in place to assess resilience and make strategic adjustments. And so for climate-related uncertainties in particular, the S2 standard requires the use of climate-related scenario analysis, using an approach that's commensurate with the company's circumstances. And the disclosures required here include an assessment of climate resilience and a summary of the key inputs and assumptions that have been used in that assessment. So we'll dive deeper into scenario analysis during the session, but a few of the key starting questions here would be just to understand how well could the company currently adapt or adjust to uncertainties relating to these risks? And how really does it need to better understand that to better know its resilience and improve upon it? So looking at a few quick examples here, our first example comes from Stora Enso, which is a Scandinavian forest products company. And in these diagrams here, they're really just showing us a summary of how their understanding of sustainability issues is informing their overall strategy and their financial decision making. So they've identified that their kind of business as usual activities relating to forests, pulp, and traditional wood products are likely to need to be supplemented by new business areas in the future. And so they've identified the growth areas connected to sustainability of sustainable building solutions, renewable packaging, and biomaterials. And then in the second part of the disclosure at the bottom, they've shown us actually how they might expect their sales revenues to change, to shift away from those traditional paper and forests products towards these strategic growth areas. And their projection by 2030 is that they would expect these to contribute 80% of their sales revenue. And so this gives a sense of how the company is kind of seeing its future unfold and how it's responding to those changes and uncertainties. And in the narrative alongside this diagram, they summarize some of the actions they're taking now to respond to this. So, for example, acquiring new businesses and taking investment currently to convert machinery into machines that will support this growth. And a second example here comes from Marks and Spencer's. I won't go into this example in detail in the interests of time, and it's a little bit small, so I'd encourage you to perhaps read it in the slides. But to helpfully kind of highlight here some of the key points that are useful, this is a summary of Marks and Spencer's risks and opportunities that they've identified. And it just shows the structure of how they've identified the potential financial impacts for each risk or opportunity, and they've connected that to their financial statements where relevant. They've also highlighted their business responses, and they've included the long-term and short-term performance targets they've set that are really helping them to strategically evaluate their progress in responding to risks and managing and capitalizing on opportunities. So I encourage you to take a look at that in the handout if you'd like to see it in more detail. But just to wrap up this section, we've got one poll question for you, which I'll launch for you now. It goes back to a concept I talked about a few slides ago regarding qualitative and quantitative information. So the question here is, when are the circumstances when a company may choose to disclose only qualitative information or a combination of qualitative and quantitative information about financial effects? So either if it can't separate those sustainability risk effects from other effects, if there's a high level of measurement uncertainty, or if the quantitative information sheds a negative light on the company. So you can select more than one option here if you think there's more than one right answer. I'll give you just a few seconds to respond to this in the interests of time, and then we'll close the poll. Sorry to move through the polls quite quickly. I know this sometimes takes a little bit of thinking, but let's close the poll there and I'll share the results because I think I can see a picture emerging. So most of you selected A and B, which are indeed the correct option. So as we covered, these are indeed criteria for when only qualitative or a mix of quantitative and qualitative information is allowed. However, as most of you identified, option C isn't correct because it's important that companies' disclosures are, of course, balanced. So if we do have quantitative information about possible material or if we do have quantitative material information about possible negative financial effects, it's important that we do provide transparency on this to our investors. And indeed, if you look at the detail of those examples that we've shared here, you'll see that there is that balance of both negative and positive impacts discussed. Great. Okay, I'll pass you back to Lois now, who's going to take us into a few climate specifics in this segment before we have our break.
Thank you, Fiona. When we talked about the governance requirements, I just want to let you know that the disclosure requirements in S1 and S2 are very, very similar. But when disclosing information related to strategy, there are additional requirements in IFRS S2 regarding climate, and we're going to talk about those now. And just to let you know, there's 3 more slides to go, and then we're having a 5-minute break. So not much longer before our break. So the climate specific strategy points in IFRS S2 first require a company to refer to and consider the applicability of industry-based disclosure topics, which are set out in the industry-based guidance for identifying climate-related risks and opportunities. So that guidance is available on the ISSB website. But for example, if you were in the construction materials industry, then the sector-specific things you might want to consider are to do with waste generation and waste recycling, percentage of hazardous waste, products that might qualify for credits in sustainable building design, and so on. So very sector-specific. Secondly, S2 requires you to provide detailed information about where in the business model and value chain risks and opportunities are concentrated. So, for example, if you have assets in an area of high physical risk, then you should disclose that. In describing the effects of climate-related risks and opportunities, S2 requires disclosure about how a company has responded to or plans to respond to the risks and opportunities it has identified. And this might include the company making a transition plan. And if it does, then that would set out how the company plans to achieve climate-related targets as a response to the risks. In providing disclosures about the current and anticipated effects of risks and opportunities on a company's finances, S2 sets out criteria for when quantitative and qualitative information is required. So qualitative information is permitted, for example, when a company cannot separately identify the effects of the risk or opportunity, or when the level of measurement uncertainty involved is so high that would make the measure just not very useful. When preparing disclosures on the anticipated financial effects, the ISSB recognises that this is a difficult thing to do, and it therefore says companies are only required to use all reasonable and supportable information available to them at the reporting date without undue cost or effort, using an approach that is commensurate with their circumstances. So that there's an easement in what is required there that we'll come back to. S2 requires a company to use scenario analysis for assessing its resilience to climate risk, but it does not tell you which scenario or scenarios are to be used. That is for the company to decide. And having assessed its resilience, the company has to provide information about that analysis, including any areas of uncertainty that it encountered, whether and to what extent the company has the capacity to adjust and adapt its strategy and business model over time. And of course, it must provide details of how and when scenario analysis was carried out and which scenarios were used. Now, I just mentioned that one of the responses to climate risk can be for a company to develop a climate-related transition plan. There's no requirement for a company to have a transition plan, but if it does, then it must provide details of it. So S2 defines a transition plan as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emission reductions plans. So going through this list of bullet points, first of all, because it is an aspect of the company's overall strategy, the climate transition plan should align with that strategy and with the business case and business motivation for it, and should use the decarbonisation levers that are most economically and technologically feasible for the company. The transition plan might also be aligned with science, including what science says about requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of science. Of course, a transition plan should have long-term goals with clear mitigation and adaptation activities to achieve those goals, but also will need interim targets and goals to monitor progress to the long-term goal. The transition will unfold in different ways for different sectors and therefore should follow sector-specific pathways, and we'll talk about that in a moment. And it should also be transparent about on what it is dependent for its success and what are the challenges or risks of lack of success of that plan. And finally, the transition plan will be read and evaluated by others and should therefore have the hallmarks of credibility. And I'll show you now where you can find those. There are lots and lots of transition plan resources, far more to list here. And the triangle on the left is really just to indicate that all of the resources are designed to support each other. So we have the transition plan task force. As we've said earlier, their disclosure specific material is now the responsibility of the IFRS Foundation. So you can find that framework on the Knowledge Hub, and that has lots of useful information for transition planning. Similarly, the GFANS, which is the Glasgow Financial Alliance for Net Zero, it has produced various types of guidance, including on sector pathways for the transition. So if you want to look at sector-specific detail, GFANS might be a useful resource. The IFRS Foundation itself has issued very extensive guidance on transition planning. That's the first little thumbnail document you can see there. So please refer to that. It's fairly new, launched in 2022. Lots of great guidance and examples in there. And finally, the SSE has model guidance on climate transition plans. And at the back of that guidance, you can find a list of the hallmarks of a credible transition plan I mentioned earlier. So this is a long training. You need a break. So let's have a 5-minute break, have a stretch, have a drink, and think of any more questions you would like to ask us. We'll play you some relaxing music and see you back here in 5 minutes. Hello, everyone. Welcome back from our break. And I'm sorry the music didn't come through, but hopefully you enjoyed some peaceful time before we move on to the third core content area of the ISSB standards, which is risk management. And this category of disclosures focuses on enabling investors to understand a company's processes for identifying, assessing, prioritizing, and monitoring sustainability related risks and opportunities, and how those processes are integrated into the company's overall enterprise management system. The questions you might want to ask within the company to help with these disclosures are: what processes and policies are being used to identify, assess, prioritize, and monitor climate-related risks and opportunities, and how, if at all, are they integrated into the company's overall enterprise risk management processes? So you might be looking at what input and parameters are used for risk management, what criteria are used, because sustainability related risks tend to have very particular characteristics. You might want to look not just at probability, but also the nature, likelihood, and magnitude of the risks. And also whether and how your processes for evaluating risks are changing over time, and whether, to what extent and how, the sustainability related risk process is integrated into your overall risk management processes. Let's have a look at an example about how the BMW Group approaches risk management. This is from their 2024 group report, and you'll know that BMW is a car manufacturer. The company, this company reports their risks and opportunities for the current and subsequent financial year. So let's have a look at the process as summarized in the diagram. Around the edge of the blue circle, we can see the word appropriateness, and this refers to the risk culture embedded in BMW's core values. We also see effectiveness, and this refers to the effective management of risks and opportunities. And in the little narrative extract you have there, BMW says that effective management of risks and opportunities is the foundation of their business success. Down the left-hand side of alongside the blue circle, we can see the group compliance and internal control system form key interfaces to the risk management system. So the process is not the responsibility of the risk department alone. Risk management has a centralized risk management function, but also has input from internal control and compliance and others. What about the process itself? You can see that in the middle of the circle, in the pale blue spokes, the process involves early identification of the risk, analysis and evaluation of the risks, the use of appropriate risk management tools, including tools for the measurement of risks. They also have a process for monitoring and assessing the measures taken to address the risk, and of course, risk reporting. So in terms of risk reporting, all material risks are reviewed by the Risk Management Steering Committee. You can see in the white circle there, and that's chaired by group controlling. And any material risks are then reported to both the Board of Management and the Supervisory Board's Audit Committee. So there's a link there from the risk management process to the governance process, illustrating connectivity that we've already talked about. Let's talk about risk management in terms of climate-specific considerations. So S2 requires companies to provide information about the input parameters they've used to identify risks, whether and to what extent they are using scenario analysis to help inform risk processes and management, and similar applies to opportunities. But what do we mean by climate-related risks? Part of identifying the risk is to be aware of what you should be evaluating to start with. So we have a definition of climate-related risk in IFRS S2 in the definitions section, and this is based on the TCFD's definitions. So there are two types of climate-related risk: transition risk and physical risk. Transition risks arise from efforts to transition to a lower carbon economy, and they're often subcategorized as policy, legal, technological, market, and reputational risks. And in the middle of the screen, you can see examples of these, things like increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, costs associated with transitioning to lower emission technology, changing consumer behavior, uncertainty in market signals, increased cost of or availability or quality of raw materials, stigmatization of entire sectors, and so on. On the physical risks, there are two types of physical risk. Acute physical risks arise from weather-related events, such as storms, floods, droughts, or heat waves, which are unfortunately increasing in severity and frequency. And chronic physical risks arise from longer-term shifts in climatic patterns, including changes in rainfall and temperature, sea level rise, changes in water availability and quality, biodiversity loss, and changes in soil productivity. Now, in both cases, in transition risk and physical risk, these can have financial effects on cash flows, access to finance, and cost of capital. And those financial effects can be experienced, can unfold over different time horizons, short, medium, and long term. So similarly in S2, we have a definition of climate-related opportunities which refer to the potential positive effects for a company arising from the transition to the lower carbon economy. So these can include efforts to mitigate and adapt to climate change by using innovation in your operations, improving processes, being more resource efficient, using lower emission sources of energy, and supporting policy incentives for new product development, for example. And you may also access new markets and take opportunities from differentiating yourself against competitors. And again, in the case of physical climate-related opportunities, there can be effects on the financial results of a company that can manifest over different time horizons. Let's have a look now at an example from the RS Group, which is a UK-based distributor of electrical and industrial equipment, and it has global operations. Earlier in the report than this extract, the company has identified climate-related risks and opportunities as one of their 10 principal risks, and this particular extract describes some of the physical risks. The most significant physical climate risks relate to the impact of extreme heat on their distribution centres, and you can see that on line 1, but also the potential for extreme weather events to cause physical damage and disruption to their customer supply operations, and that's on the second line of the table. Little red wheel icons show that strategically the risks mainly affect operational excellence, and other icons show the stakeholder groups most affected by the risk, so they're connecting the effect of the risk to strategy and to stakeholders. In the extract, you also see a description of the risk, who the business owner is, what metrics are used for monitoring the risk, and in the final column, what actions are being taken to manage the risk. And these include things like building upgrades and associated capital investments and business continuity plans. And elsewhere in the disclosures, you can see a lot more information on the projected financial impacts of the risks under different scenarios. And they express this in terms of the impact on future annual operating profits. So Bella's going to take us through the final core content area now.
Thank you, Lois. Yes, Lois is right. Let's now spend some time on the last core content areas, metrics and targets, the final core content area of the standards. So here, disclosures are intended to enable investors to understand how the company is performing with respect to its sustainability-related risks and opportunities. Let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. What is the method of calculation? What were the inputs? Are there limitations? And what assumptions are involved? And regarding the targets, requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals, as well as any targets it is required to meet for regulatory purposes. So disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And disclosures also include the metrics used to set the target and to monitor progress towards its achievement, the baseline period from which progress is measured, and the period to which the target applies. And disclosures also include what are the milestones and the interim targets, if there have been any revisions to the target, together with an explanation about the revisions. So let's spend some time to look at the example from CLP group. So over to you, Lois.
Yes, thank you, Bella. And I'm sure many of you will have noticed that lots of the examples we've shared to date are really focused on climate change. But S1 requires companies to report on all sustainability related risks and opportunities. So here we have an example from CLP about waste management and material use. And CLP is one of the largest investor-owned power businesses in Asia Pacific, and aims to be a leading responsible power provider. And here, very briefly, in this extract from its 2024 sustainability report, CLP is showing waste management and material use metrics for 2024, including the percentage of pollution the company reduces through recycling and removal activities in line with its circular economy strategy and principles. So in the little narrative, in the text there, the company sets out its strategy and its targets for waste management and material use. And you'll see that in the table below, they're tracking they're showing you their actual results for 2024 and tracking progress towards their targets. Now, some of you have said in the chat and in the questions, well, there's only a standard for climate. However, as we'll come on to see, companies can use other frameworks and methods for calculating metrics related to other subject matters. And you can see that in the pale grey text in this example here, CLP tells us that they have used the SASB and GRI frameworks to calculate their waste management and material use metrics. So I'll hand back to Bella now to take us through more metrics and targets.
Thank you, Lois. Yes, now let's talk about some of the climate-specific considerations for disclosures on metrics and targets. In relation to metrics, IFRS S2 requires a number of specific disclosures, including disclosure of industry-based metrics relevant to a company's business model and activities. Additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and the associated joint ventures, and the information about the company's financed emissions. In addition, ICE2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While ICE2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, ICE1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We will share the link in the chat, and you can also find it on the SSE's website. As for metrics, there are some climate-specific disclosure requirements in ICE2 for targets as well. For example, ICE2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. ICE2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And ICE2 also includes additional requirements to disclose information about the approach to setting and reviewing each target and how it monitors progress against each target, including whether the target was derived using a sectorial decarbonization approach. Questions on GHG emissions often come up in questions on metrics and targets disclosures. So we wanted to address some of these briefly. For those who might not be familiar with the different scopes, I would like to introduce a little bit. For Scope 1, that includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat and cooling, such as the electricity you purchase. And the Scope 3 is all other indirect emissions that occur in the company's value chain. ICE2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in the first year of applying the standard. And ICE2 also requires a company to disclose whether and how the company is using an internal price on carbon for decision-making and whether and how executive remuneration is linked to climate-related considerations. On 29th of May of 2025, the IFRS Foundation has published educational material, which was presented in a Q&A format detailing the greenhouse gas emissions disclosure requirements under IFRS S2, including measurement, use of the GHG protocol, and how to report Scope 1, 2, and 3 emissions in line with the standard. Okay. So I think it's time for examples again. Over to you, Lois.
Thank you, Bella. And this is an example from Vale's integrated report. And Vale is a metals and mining company. And it shows how they report and break down their greenhouse gas emissions, which they call the greenhouse gas inventory. The tables, a main part of the diagram are tables, and they show greenhouse gas emissions broken down by scopes 1, 2, and 3. But they also show us, as well as the year 2024, they show us comparative figures dating back to 2022 and to the baseline year for their targets, which is 2017. The circular diagram on the right of the screen shows greenhouse gas emissions broken down by the source of the emissions. So in this case, mobile combustion activities give rise to the most greenhouse gas emissions by source, followed by industrial processes. So for readers that want to know where the emissions are coming from, this breakdown is very helpful. Notes and symbols, a bit small to see here, but the notes and symbols tell us how the results have been prepared. So in this case, the inventory was prepared using GRI's greenhouse gas emissions standard. Another note tells us that the emissions have been reported on a gross basis before any type of compensation or mitigation, and that is what IFRS S2 requires. At the bottom of the page, they give us an overview of the company's long-term commitments and a report on their progress. And the bottom of the screen just explains what progress is being made towards the targets that the company set in 2017. So we have a breakdown by scope, comparative analysis between years, a breakdown by the source of the emissions, and a statement on progress against targets. Let's go to a Zoom poll now. And the question is, what is the objective of metrics? And in particular, what is the objective of the ISSB's disclosure requirements about metrics? You can answer all that apply. Let's have a look at the results here, because I can see you know the answer. Strictly, the answer is A and B. Now, the reason we've asked the question in this way is to encourage you always to read the standards themselves. They're quite short and easy to read, and at the start of each of the content areas, the standard sets out the objective of the core content area. So in the case of metrics, the objective of the disclosures is to help readers understand the company's performance in relation to its sustainability related risks and opportunities, and to understand progress towards targets, as we saw in the Vale example. Now, it might be that the metrics also help the reader understand the company's assumptions for the future. That's great, but it's not strictly the objective of the metrics, which is A and B. So if you really want to focus on your disclosures to answer the objective of the standards, read what it says about the objective at the start of each core content area. So we're going to move on now we've covered the core content areas. So we're going to move on to look at what happens if you want to make additional disclosures that is additional to what the core content areas of the standards require. How do you integrate those disclosure requirements with the baseline? We've already talked about the baseline, haven't we? That this is the common language for sustainability disclosures set out in the standards. But we know that jurisdictions, stock exchanges, and others might want to request companies to provide information in addition to the baseline, because there are listing requirements, because it's helpful to conform with policy objectives such as there may be an offer of incentives like tax cuts or subsidies for sustainable practices, and you need to provide information about that. Or you might want to provide additional disclosures to align with emerging industry standards, or to respond to stakeholders in addition to investors. So we've talked about the fact that the baseline is in the standards, and the ISSB is working with national regulators to consider how they could incorporate ISSB standards into their domestic frameworks. And we know that in your particular jurisdiction that is in progress, as was explained at the start of the presentation. So I will not go into this in detail. Suffice it to say that there are over 40 jurisdictions that have adopted, use, or are taking steps to adopt the ISSB standards. And if you'd like to know more information about the progress of adoption, then we supply links here and in the handout to where you can find further information. We know that some companies on this webinar are already using different frameworks in addition to the ISSB to support their reporting. And point to make here is that the ISSB is working with other organizations to ensure interoperability and alignment as far as possible with the ISSB standards. We've already talked about some of these, so I won't go into it. I'll just mention that the Greenhouse Gas Protocol, which is the protocol that must be used for the calculation of greenhouse gas emissions under the ISSB standards, with certain exceptions, is the ISSB work closely with the Greenhouse Gas Protocol team, both in terms of technical input and in terms of governance. The other one to mention from this list is the Task Force on Nature-related Financial Disclosures, some of you might be familiar with, and the ISSB currently has a project to develop nature-related disclosure educational material or standards, and is considering how to build on the TNFD's recommendations. In terms of GRI, I think the one important thing to say here is that in terms of climate disclosures, the GRI's standard setting board has granted equivalence to IFRS S2. So to be able to use the equivalent IFRS GHG emissions disclosures, organizations reporting in accordance with or in reference to the GRI standards will have to measure their greenhouse gas emissions in accordance with the Greenhouse Gas Protocol and include a reference to the location where the information for each of the disclosures can be found. So you can find more information about that in the joint statement that was made about equivalence. But there are other forms of collaboration between ISSB and the GRI. For example, as I mentioned about the ISSB's work on biodiversity ecosystems and ecosystem services and nature. They're considering how to use GRI's standard on that to make them fully interoperable as much as possible. And of course, they have some governance arrangements such as co-convening GRI's Sustainability Innovation Lab in Singapore. Now, I don't think this is so much for this audience, so I'm going to just say one thing about the way the ISSB works with the standard setter in Europe, and that is that they aim for a high degree of interoperability, and studies so far show that there is such a high degree of alignment related to climate-related disclosures. Some of you know that the European standard setter is looking at simplification of their standards, but the intention is for interoperability. I know that some of you are using the integrated reporting framework, and as we saw earlier, the integrated reporting framework has been consolidated into the ISSB's work. So you're encouraged to use the integrated reporting framework as a complementary tool for your sustainability disclosure. Just one thing maybe to say about the integrated reporting framework, it also focuses on investor information needs. It really helps to provide a holistic view of the company's value creation process, but it's underpinned by integrated thinking. And this integrated thinking can really enhance the quality of a company's corporate governance. So if you're interested in using integrated reporting to support your sustainability disclosures, there is a guide that we provide a link to there. So I think we've just got one more Zoom poll now before we move on to our summary of Module 2. And here you can only select one answer. So when you're thinking about your disclosure objectives, should you consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above? I can see immediately that you all know the answer to this question. So I'm going to share the results with you in the interest of time. Yes, of course. You consider the ISSB standards, regulatory requirements naturally, and other sources of guidance, as we've seen from some of the examples. So well done for answering that absolutely correctly. And Fiona will take us through a summary of Module 2 now.
Great. Thanks so much, Lois, and well done, everyone. We have come to the end of our second module. Now, you might be thinking, well, 2 modules out of 4, are we only halfway? Don't worry, module 2 was a big one because there was a lot to cover to get through all of the content areas of the standards. So we're well more than halfway through our training, you'll be pleased to hear. But just taking a moment to wrap up on this module. We reviewed all 4 of those core content areas of the ISSB standards: governance, strategy, risk management, and metrics and targets. But an important thing I think to remember here is that these areas, of course, don't operate in silos. And we saw in our examples that despite these being 4 separate categories of disclosure, of course, in practice, they're all interconnected. And that's what we want to bring out in our disclosures as much as possible. We also discussed how your disclosures may go beyond the requirements of IFRS S1 and S2, for example, to meet different stakeholder needs, perhaps to meet regulatory requirements in certain jurisdictions, or to meet industry standards. But what's important to remember when you're doing this is that the ISSB standards have been designed to act as that global baseline. And so the building blocks approach does allow report preparers to add additional disclosures on top. But in doing so, you do need to be careful that you don't obscure the requirements of S1 and S2 as well. So let's take a moment now to reflect again in another Menti exercise. So in our module Align, we've heard a lot about the particular content areas that you need to disclose to meet the requirements of the IFRS S1 and S2 standards. And likely that will have brought to mind already for you some potential gaps that you might see. So what we'd like to do is just take a moment to share together any gaps that we've identified or observed, just to make a note of those. Now, of course, what we would recommend that you do outside of this training is to probably do a more structured gap assessment. And there is a gap analysis checklist that the SSE has developed as part of our toolkit we shared with you that can support you on this. Then within the homework assignment, you can use that plan there to develop your approach to addressing the particular gaps. And there may be different kinds of gaps for different companies here. It might be that you have particular content areas that you need to disclose that perhaps are new to you. Or maybe there are different processes that you need to set up internally, maybe different resources or skill sets that you need. But let's take a moment to have a think about that together, just so that we've, I guess, reflected whilst it's front of mind on those key gaps. Of course, you may have several gaps, and that's completely normal. So don't feel like you have to think about everything in one go, but maybe just think and share what's front of mind for you at the moment that you've heard from what we've talked about so far. So the link to join us is in the chat again if you need it, but hopefully you've got it open. I see some of you have already shared. Someone here has mentioned quantifying their sustainability and climate risks and opportunities and linking them to financial information. Indeed, I think that is obviously a key objective here from these disclosure requirements, that we really connect sustainability reporting to its financial effects. But of course, that's for many organizations a new element and something that can be tricky. We'll go into a little bit more on that in Implement as well. Data availability is coming up several times. See here, maybe not being able to get the data that you need, and challenges in quantifying things. I think, again, all very normal things to start with. And really what I think is going to be important to do is to map out what data you have, what data you may be able to get, and perhaps things that you can estimate and use proxies. So if you refer to the IFRS materials, there's kind of a hierarchy there of data approaches depending on whether you can get primary data, whether you can make estimates if you need to. So there are provisions built in there to support you in navigating those data gaps. See a few mentions of kind of climate specifics as well. Maybe people are mentioning scenario analysis and scope 3 as 2 topics I see coming up here as quite new. Of course, that's the case for many organizations as well. I think with scope 3, it's often a case of starting by just getting a sense of what your scope 3 emissions categories are. So screening all of the categories that exist to identify those that are relevant for your organization. Likely some of them you'll be able to rule out from that process. And then you'll also probably have a sense of which ones are going to be most significant for you. So recommend starting with where your most significant scope 3 emissions are and working from there. So, for example, for many organizations, that could be the use of their products, or it could be their suppliers. So, two key areas perhaps to understand depending on the nature of your business. Someone's mentioning also maybe knowledge and skills. Absolutely. It might be that you've been tasked with focusing on this topic, but it could be that it's quite new to you. I think a few key things to do there. One would be to bring together as much internal capability as you can from different functions. So this is not going to be a one team exercise. It really needs to draw across sustainability, risk management, financial accounting, and then also the operational teams or functions that may hold some of this information, for example, HR, procurement. So really drawing on your colleagues there, but perhaps as well making the case internally for extra resource, because of course this is likely to be quite a step change, and therefore it's logical that you may need some further support for this. So mapping out what skills you have and maybe any areas that you may need to supplement with new hires or with consultancy support is a good idea for sure. Great. Thanks for those reflections, everyone. I think it seems lots of areas to move forward and think about, and we'll continue to build on that in our next exercise when we think a little bit more about how to address some of these areas. Great. So let's go back to the slides, and I'll hand you to Lois now, who's going to get us started on module 3.
Thank you, Fiona. Yes, module 3 we are calling Implement. And we've looked up to now about what disclosures a company is required to make. So what is the content of disclosure? But this module is a bit more about how that's done, starting with the practices and processes needed to collect appropriate data for disclosure. So we're going to look at 3 things. First of all, how to identify sustainability related risks and opportunities. Secondly, evaluation techniques to help with the preparation for disclosure, and this will focus on scenario analysis. Fiona will cover that. And thirdly, how to integrate processes needed for sustainability disclosure into your existing processes. So identifying risks and opportunities. Now, IFRS S1 asks companies to provide material information on all sustainability-related risks and opportunities that could reasonably be expected to affect a company's prospects. And S2 sets out requirements for climate disclosure. But what do you do about risks and opportunities beyond climate? Well, S1 directs companies to sources of guidance that can support the identification of risks and opportunities and information to disclose about sustainability matters other than climate. First of all, when identifying which sustainability-related risks and opportunities to report on beyond climate, S1 says that consideration must be given to the SASB standards. And as we know, these are the sector-specific standards, and they set out disclosure topics likely to be most material for the sector. So a good starting point. In addition, companies may consider other sources of guidance, including IFRS educational material on sustainability-related risks and opportunities, and disclosure of material information. We've provided a link for that in some of the Q&A boxes, and very comprehensive guidance there. You can also look at the CDSB framework application guidance that covers a range of subjects, including water, forests, human rights, and so on. You could look at your own industry practice guidance for resources to help with disclosure, and also the materials of investor-focused standard setters like the integrated reporting framework. So having looked at those different sources, you'll then be thinking, well, what information should I report about the risks I have identified? And again, the same sources may be referred to, but in addition, you can refer to GRI standards and the European Sustainability Reporting Standards. And this is exactly what we saw happen in the CLP example, where they were reporting about waste management. So let's have a look at an example. And this is an example from IALA about their risk process. So it starts with communication and consultation. They communicate with and consult a range of different stakeholders just to understand a wide range of perspectives on a risk. The first step in their process then is to establish the context, which will be informed by that communication exercise. So the context is the risk environment in which the company operates. So they look at a range of internal and external factors to understand that. Secondly, they assess the risk. Thirdly, they decide how to treat the risk. And finally, they have a monitoring and review process. And you'll see that in each of these steps, they tell us who is in charge of the particular step and what output is expected. So in the case of monitoring and review, they will update IALA's risk portfolio risk management report. So some connectivity between the two things there. Let's have a look at another example, slightly different type of example on identifying risks and opportunities here. This company, Nest, based in Finland, is a leading producer of sustainable aviation fuel, renewable diesel and feedstock solutions for the chemical industry. So it's using science and technology to transform waste and other resources into renewable fuels and circular raw materials. The extract is from the climate section of their 2024 annual report, and it shows how they identify risks and opportunities in two different scenarios. The scenarios are a net zero scenario, and they consider that on a global basis and also looking at the EU and North America. In both cases till 2050. They split out that net zero scenario because different jurisdictions are likely to take action on different timescales. And in the net zero scenario, they anticipate that climate action will be rapid and radical and will aim to keep temperature rise to no more than 1.5 to 2 degrees above pre-industrial levels. Now, in the case of the net zero world, they anticipate opportunities, of course, because they operate in the renewable sector, and they have described that in the disclosures there. There's another scenario, though, which is the compromised climate target scenario, where they anticipate that climate action will be slow and global warming of 2.5 to 3 degrees C is expected. In this case, the company will have opportunities by differentiating itself from others, but the risk is that the demand for their products will be constrained. Now, one other thing to notice about this example, that they give an indicative financial impact of the risk or opportunity in these cases, and the most positive financial impact is in net zero world 2050 scenario, which you might expect because the opportunity here is that there will be accelerated global demand for their products. Slightly different approach there. So I've already mentioned this, so I won't go into it in detail, but suffice it to say that the ISSB recognised that identifying risks and opportunities is challenging but valuable, and they therefore say that companies are only required to use all reasonable and supportable information available at the reporting date without undue cost and effort. So what do we mean by this? What we mean by reasonable and supportable is that the information is specific to the company. So the company should know that. It takes account of the external environment, so the environment in which the company operates. And we saw that in the IALA example, that was their step number 1. It includes information about past events and current conditions the company will know about, but also forecasts. And perhaps this is what Nest was getting at. They were trying to forecast the effect of their risks and opportunities using scenario analysis. And in some cases, the disclosure standards specify what the reasonable and supportable action should be. So we're handing back to Fiona now for the next part of our implement module.
Thanks, Lois. So, next part, we've evaluated risks now. So we started with identifying them, and now we're looking to evaluate the risks and opportunities and test our resilience. So, to help investors understand a company's resilience against climate risk, S2 in particular asks companies to disclose information about the impacts of climate change on its strategy and business model, and for the company's financial and operational capacity to adjust or adapt over short, medium, and long term. And so, as we heard in Align, this is where companies are asked to use scenario analysis. So, we talked a little bit about it already, but let's go into a bit more detail. So it's important to be clear that S2 doesn't specify exactly which approach a company should take here or which scenarios it should assess, because that really is highly dependent on the sector of the company, its geography, which type of climate risk it wants to assess, what time horizons it's using. There are a whole host of tools available out there, and I know that question has come up a number of times in the Q&A. So I've shared a link to our FAQ database from this training where we do list a number of different scenario analysis tools that you might want to consider looking at to help get started here. But overall, companies are asked here to use relevant scenarios to provide information about which it's selected, and to disclose the relevant assumptions that sit behind those scenarios. And in the guidance that sits alongside the standards, a range of different approaches are described here. So it may be that a company who is brand new to this topic starts with a qualitative approach using narrative scenarios. And then over time, you might want to build towards more advanced or quantitative methods, focusing in particular on areas that you feel will lead to material information for disclosure. But overall, again, companies are asked to use an approach that is commensurate with their circumstances. So looking at one example here, just to show us an inspiration for what this could look like. You probably know the Swiss multinational company Nestle, food and drinks company, and this is just one of the many outputs of their scenario analysis, which you can find in their non-financial statement. This one shows their projections for how changes in climate under an intermediate emissions scenario could affect the yields of their agricultural commodities that they rely on. So they expect to see declines in yield in certain parts of the world, increases in others. Overall, therefore, potentially quite significant changes in the prices, availability of key inputs for them. And so their disclosures summarize the inputs to this analysis, the aspects they've considered, and therefore some of the conclusions that they've made about how they can improve their resilience to this uncertainty. So, for example, they're taking steps to invest in R&D, leveraging crop science to improve their strategic and financial planning, and to engage and advocate for better policy as well. So, of course, we know that when we're talking about anticipating the materiality of information for possible future events, that's quite a challenging thing to do. So, to help with determining this, IFRS S1 asks you to consider a number of issues to help you with this determination. So, I won't go through this entire list, but you can see here and refer to it in the slides, a list of the different types of factors that companies need to continue to evaluate. So whilst it's not required that you complete a scenario analysis every year, because scenario analysis should really be integrated into your company's own strategic planning processes at whatever cycle periodicity those are. It is important, however, that these uncertainties are still assessed each reporting period so that you make sure that your conclusions are still continuing to be valid and up to date in line with any changes that have been on that front. Okay, back to you, Lois, now for our last unit of this module.
Thank you, Fiona. So we're now turning to look at how you can develop or your existing or new processes to integrate sustainability related disclosure processes for your to help you. Well, there's two things to say here. First of all, good news. You're likely to have something in your company already that you can use to help with your sustainability disclosure. The other thing to note is that the ISSB standards do not stipulate how you should develop systems and processes for sustainability disclosure. They focus on content, not process. So this list here comes from the WBCSD Disclosure Handbook. I won't go into them in detail, but the sorts of things you might want to look at to test whether your systems are already appropriate or need to be developed are to undertake a gap analysis to see, check for gaps in existing systems and processes, to look at the suitability of the process and the criteria you use. Sustainability related risks and opportunities are uncertain, they manifest over longer time horizons, so you might need different criteria to assess and monitor the risks, such as likelihood, impact, vulnerability, and speed of onset. You can also not just look at enterprise risk, but other systems to help, such as internal risk systems. Importantly, you'll want to consider who in your organization or elsewhere has processes, systems, information, expertise that can contribute to sustainability disclosure, how you can interconnect different internal and external factors to support your disclosures, which uncertainties you'll be dealing with and how you want to deal with them, what judgment process you'll apply to those uncertainties, and whether and to what extent you're going to need extra resources to develop existing or make new processes and systems. Do you need to go through a budget application process or a change management process? So it's sort of like, what have you got? Who can help? What resources do you need? Now, we're suggesting in your homework, which is voluntary, as we've said, that you develop a disclosure plan to consider some of these things. It's a great way to integrate sustainability-related risks and opportunities into an organization's practices and policies. So it helps a company take control of its narrative because it very much focuses on your strategy, the risks you have identified. It's not generic. A disclosure plan is specific to your company. It allows you to think about things like what audiences you want to communicate with, who will be involved in developing disclosures, how those individuals and departments will be organized, what their responsibilities will be, how you'll get data to be sourced, whether you will have your information assured, what sign-off procedures you'll use. So the disclosure plan records all of these things and can support internal collaboration, knowledge sharing, and team working. But I think most importantly, by recording all these things, you have a central reference point, an audit trail, explaining where information came from, who was involved, how judgments and decisions have been made. So here's an example of the type of thing you would expect to see in a disclosure plan. It's from Novo Nordisk, which is a Danish pharmaceutical company. I won't go through it in detail, but in the first paragraphs, they're outlining the regulations, standards, and practices they've had to or chosen to use for disclosures. So you'll see there's a range of things like the Science-Based Targets Initiative, the Greenhouse Gas Protocol, but also the laws to which this company is subject. They explain what time horizons they've considered in the preparation of their disclosures. They define what they mean by short, medium, and long term. They explain how estimates have been used and where more information can be found about assumptions and uncertainties. And they provide lots of other contextual information that really helps the reader understand how this company has prepared their sustainability statement. So let's have a look at another Zoom poll now. And this one asks, you can only answer yes or no. And it says, is a disclosure plan required by the IFRS sustainability disclosure standards? You can answer either yes, and you must disclose your plan, or no, but it's a very helpful tool. I'm just going to give you a minute to think about this. Let me share the result now. You can see that you're quite split on the answer to this. Most of you are right. Most of you are wrong, I'm afraid. The correct answer is no. There is no requirement in the IFRS sustainability standards for there to be a disclosure plan. There are certain requirements that say that you must disclose the methodology that you have used or the approach you've used for preparing certain types of information, but there's no requirement to have an overall disclosure plan. We're just recommending it for your voluntary homework because we think it's very helpful. So the correct answer is no. So well done to those of you that got that right. We've got one more Zoom poll now, just because we like your involvement. And this asks, a disclosure plan can do what? It can help a company to take control of its narrative, to support collaboration, to act as a reference point, or to skip full disclosure as required by the ISSB. You can select all that apply. Again, I can see that you all know the answer to this because you're listening carefully, and I thank you for that. Yes, of course, it's the first three, as I said earlier, and it is not an excuse to skip full disclosure as prescribed by the ISSB. So well done, and we'll go back to Fiona for a summary of Module 3 now.
Thanks, Lois. Apologies, getting a bit distracted. I think our Menti's been hijacked by someone trying to sell us chicken burgers, but we'll see how well that works for us when we get to it. It's a strange problem I've never had before. But anyway, before we come to that, let's wrap up this module and just remind ourselves of a few key things. So firstly, we'll come back to connections. In the last module, we highlighted the connection between different content areas of disclosure. And then in this module, we also learned that there are many connections between a company and its external and internal environment. These connections are really what we need to focus on to identify key risks and opportunities. And then the second thing we talked about here was related to evaluating the risks and opportunities. And a key component of that evaluation is consistency in your assumptions. So, scenario analysis can, of course, be a very helpful tool because it helps us to keep track of those assumptions. And if you're new to this, that's where using some of the pre-packaged scenarios can be helpful. So I've mentioned already, I recommend checking out the SSE's FAQ database, which I've shared in the answers a few times in the Q&A. We've got a question there on scenario analysis number 12, where we list a number of different tools that you might want to refer to help you get started. So helpfully, I think those tools give you a number of suggested assumptions that you could base your assessment on. And then finally, as we've seen, even if some of this data might not be data you're already disclosing, or maybe already it's something you're collecting for different reasons, it could well be that you have the appropriate practices in place to enable you to collect that data. So as much as you can, try not to start from scratch, build on what information you already have, or build out from existing processes that you already have in your organization. So let's finish off this module with our exercise then. So this exercise asks us to think about how we might approach plugging some of those data gaps that we talked about. I know many of you mentioned data availability for scenario analysis, for scope 3, for risk assessment was one of your key gaps in our last exercise for Align. Now we'd like to take a moment together to brainstorm really on how we might go about addressing that gap. So some of the things we could think about here would be either where we might have data in the business already that could support us, or maybe we have processes that we can use to enable us to collect new data or to estimate things. So we'll take a moment together in Menti. So I'm just going to have a go at refreshing the results for the slides to reduce the emphasis on chicken burgers, and then we'll see what you guys think about this. So the link is the same as before, but I'll just reshare it again so that you have it in the front, and then I'll reshare my screen. Oh no, it's chicken burgers again. We'll try and ignore the chicken answers and focus on the other ones. Although, as you say, Lois, I think if the burgers are sustainable, then at least that would be right. But I don't know how sustainable they might be. We'll see. But anyway, we see here mentions of sustainability data helping organizations and Microsoft Forms. Someone else has mentioned the ERP system or KPIs. Exactly. There's going to be a lot of information that you're already collecting through your financial reporting and other reporting systems that can really inform you here. This is very strange. We've never had this before, but clearly someone really wants you guys to enjoy some fast food. We've got data accounting as well. So that's the same thing. SAP. Someone's mentioned sustainability portals. So maybe you're already collecting information, perhaps environmental information, for example, for assets, operational reasons that you could use to support you here. We've then also got many people mentioning kind of adapting the financial systems. I think that's a really good idea because actually those systems are going to be built with the right sorts of controls, quality assurance processes around them, right workflows that will support you in collecting good quality data. So I think that is a good idea. Someone else has mentioned monthly management reporting, maybe having questionnaires or Microsoft Forms. Maybe you want to ask your stakeholders to better understand from employees, from wider suppliers, for example, what data they have available, what their risks and impacts are. Centralized systems, someone's mentioned. Maybe someone's mentioned that the government data might be available. Yeah, so governments often might give you emissions reporting factors, for example. They might give you data sets that you can use to estimate things if you need to. Let's see, what else have we got? Maybe someone has said having dedicated personnel, I think, for data collection and review. Yeah, that might be something that you identify from this, that actually you do need to put more resource on data collection to focus on it specifically. So indeed, that's a highly possible route that you might want to consider. So what else do we see? Variance reports. Someone's mentioning operational logs, procurement and compliance monitoring. Definitely, because I think if you're looking for data on supply chain risk, which for many organizations, the value chain will be quite a key consideration here, you may well have already collected information as part of pre-qualification questionnaires, due diligence process of suppliers that can really inform this. Let's see, what else have we got? Quality circles, so maybe your quality assessment or management processes. Someone here has mentioned as well, exactly. Thank you there for the response on this. So someone's mentioned also ISO standards, so 50,001 on energy, 14,001 on environment. Exactly. So if you already have those ISO standards in place, they already require you to collect and review data. It might be that you're just using that information internally right now, but actually repurposing that information for public purposes could be indeed a good step to bridge between those two. So I think this really highlights what we were hoping to from this exercise, that of course there are loads of sources that you can draw upon here. We know it can be quite overwhelming, I think, when we're getting started to think about where to begin here. I think the key thing we'd really recommend is actually just mapping out all of that data that you have, thinking about which of it is kind of in a readily usable format, maybe considering what changes you might need to adapt to enable you to use it for the future. So lots of good ideas, I think, here for inspiration. Another thing I think that's really key here is trying to embed at outset the right governance processes. If you're setting up new data processing systems, being sure to do so in a structured way with the right kind of checks and approvals, making sure you've assigned a clear accountability for data is definitely a good approach to ensure you're setting yourself up in a structured and controlled manner moving forward. Great, thanks everyone. Lots of great insights and indeed some menu inspiration for everyone's dinner as well as an added bonus. But thanks for all of the answers. We'll go back to the slides now and we'll get started on our fourth module.
Yes, that's great. Thank you, Fiona. And hello, everyone. My name is Robert Witowski. I'm a partnership manager at ISSP Foundation, IFRS Foundation. Indeed, we'll go to the next and the last module of this training. Fiona, I don't think I have an access control over the slides at the moment. Yeah. Yes, great, I do now. Thanks. So we'll then go into the final unit. We'll then focus on the aspects of when and where in terms of disclosing sustainability-related financial information. And there will be 3 sections here. And location, about location and timing, about efficiency, and getting confidence. So let's start talking about locations, and we will then clarify where sustainability disclosure should be located. But before we get into the details and specific requirements of the standards, it might be helpful to think about sustainability disclosure in the context of a complete reporting package that is useful to investors. So as previously mentioned, the requirements in the ISB standards are based on addressing the information needs of investors and effectively build on past standards and frameworks such as the CFD and the SASB, which are similarly focused on investor information needs. So one of the major advancements that the ISB standards bring in is the rigor of accounting and a focus on connectivity to the financial statements. So while ISSP and GRI standards do share some common requirements, that is what information to report, they differ in terms of the overall objectives. So as I said before, the ISB standards are really focused on investors' information needs and decision making. That is information about sustainability-related risks and opportunities that could reasonably be expected to affect companies' cash flows, access to finance, of course, or cost of capital. So in comparison, the objective of GRI standard is broader, and this is to elicit information about companies' impacts, regardless of whether or not this impacts a company's financial performance. So as a result, ISSB and GRI take a different, although complementary approaches to materiality. And in practice, the GRI approach is more commonly understood among sustainability practitioners, where IFRS approach should be more familiar to accounting professional and finance executives. So in summary, many of the impacts traditionally identified as material in the GRI standards may give rise to sustainability-related risks and opportunities that are likely to affect the company's prospects, and therefore investors would also be interested in the information about them. So you can find some additional information about potential areas of focus for primary users, that is investors, in your handouts. Right, so what is material information? So now moving to materiality, you probably come across different references to different types of materiality based on different reporting standards and frameworks. So it is helpful here to briefly recap what we mean by material information when it comes to ISSB standards. So as we discussed in the first module, information is material when it influences decisions of primary users of general purpose financial reports, in other words, investors, and informs their decisions about things like providing resources to a particular company, buying, selling, or holding equity or debt instruments, granting loans, and other forms of credit. as well as voting on or influencing how management uses in company resources. So in this context, when preparing disclosures, the key consideration here is the characteristics of the investors and the company's own circumstances. So what I mean by that, for example, different investors can have a different and sometimes conflicting information about information needs. And therefore, the intent of sustainability-related financial disclosures under the ISSB standards is really to meet the common information needs of investor, and is really about the key information that an average investor would be looking for. The important thing is to remember that materiality is a characteristic of information, and the ISSB standards take a two-level approach to this. So first, the first step will be the identification of sustainability-related risks and opportunities that is based on what investors expect to affect the company's prospects. And then the next level will be to disclose what is material information about those risks and opportunities which investors need in order to make decisions. So yeah, I hope that it's clear now. There's sometimes it causes this confusion about, and then we often hear the term material risks. And this is, I know that this is what risk professionals and executives and management sometimes talks about, because that's what they are used to. But strictly technically speaking, when referring to the IFRS standards, we should talk about material information in relation to the sustainability-related risks and opportunities, not as material risks per se. So now let's talk about disclosing material information and what it does mean under ISSB standards. So IFRS S1 requires that material information be clearly identifiable and that the information itself is clear and concise. And what it really means in practice is that material information should not be obscured by other non-material information. For example, by information that a company discloses on the basis of, say, another framework is not centered on the information needs of investors, but maybe focused more broadly and includes different types of stakeholders. So why is it important? So first, the location of sustainability-related financial information with a general purpose financial reports might vary between companies across different jurisdictions. And second, information designed to meet the needs of other stakeholders beyond investors might be provided voluntarily or to meet regulatory requirements. So the potential problem here is that material information reported under ISSB standards could be obscured because it might be buried amongst other information that has been prepared for different purposes or accounting to different objectives that don't necessarily align with the ISSB requirements. So this could also be problematic in case where reports are perhaps poorly organized in terms of the content, and therefore material information is scattered throughout the report. And again, this is important because a company won't be able to assert compliance, which we'll talk more about later with the ISSB standards, if a report is overloaded with irrelevant data, or it blends information for different audiences without clearly identifying the information that is material investors. As mentioned previously, the IFRS Foundation has published educational material back in 2024 on this topic to really help provide additional guidance for companies on identifying and disclosing material information. So please do check this out. Right, now it's a time for a quick poll. So the information, if the question is about the characteristic of the information, you should see the poll on your screens right now. So information should be disclosed in the annual report when applying the ISSB standards. If, and please do select all which apply here, omitting that information could reasonably be expected to influence investor decisions. It could affect the company's cash flows. It exemplifies the values of the leadership team. So please do check the ones which apply here, and potentially more than one. I'll give you a few moments to think about this question. If you listen carefully, that should be straightforward. Right, so the correct answers here are A and B. So it's not about values of the leadership team. It's about the information which can influence investor decisions or affect companies' cash flows. So this we should have in mind when thinking about material information about sustainability-related risks and opportunities. Okay, so congratulations to the ones who did it correctly. I'll be moving to the next part, and then the next topic here, and it's about the location of the report. Under the ASB standard, the standards must be available at the same time. The disclosure must be available at the same time on the same terms as the financial statements. That's what it's stated in standards. That is, they should be a part of the same general purpose financial reporting package. So that said, IFRS does not have a requirement that specify the exact placement of that information. So that means that ISB standards don't specify where within the overall reporting package the information has to be provided. And this is really by design in order to give flexibility and accommodate jurisdiction-specific requirements on the location of the reporting. The most important factor to consider here is, though, to ensure that sustainability disclosures are for the same reporting entity as the related financial statements. And again, they are disclosed at the same time as the financial statements covering the same reporting period. It's worth noting that standalone sustainability reports are not prohibited by the ASB standards, provided that report forms part that the report forms a part of the general purpose financial reporting package. So, for example, a company might choose or might be required by local jurisdiction to have a distinct sustainability report that is issued alongside of a broader annual reporting package. And in practice, this is where the use of cross-referencing plays really important role. So that is that the cross-reference information must be available on the same terms at the same time, and this is as the sustainability-related financial disclosures I've already mentioned. And importantly, the complete set of disclosures must not be less understandable by including information by cross-reference. So again, cross-referencing information also becomes part of the complete set of disclosures made under ISSB, and such must comply with all the ISSB requirements, including things like being relevant, comparable, verifiable, timely, etc. And to get the better idea how that might work and look in practice, we'll have a short example here. Over to you, Lois.
Thank you, Robert. And rather than an example, we have here the results of a study by the World Business Council for Sustainability. It is for Sustainable Development. It's from their 2025 Reporting Matters study, which is an annual review of corporate reporting from a selection of global companies. And in the dark green boxes at the top, it shows the general approach to reporting. So standalone reports remain the predominant approach in 2025, with comprising 54% of reports in this year's sample. But as you can see from the comparison with 2024 and 2023, the approach of standalone reports is decreasing slightly and gradually as the years go by. And this is probably because of the shift towards reporting financial and non-financial information within the same document, in line with mandatory requirements that are coming in many jurisdictions. At the bottom of the screen, in the green boxes, green graphs, we can see the differences across jurisdictions. So standalone sustainability reports still predominate in the Americas, representing 81% of reports. You can see that it's much lower in MEA, which is 39%, and perhaps this reflects the regulatory developments in that area. So this is a useful publication to refer to if you'd like to know more about disclosure examples and trends in reporting. But for now, we'll go back to Robert to tell us about digital reporting.
That's correct. Thank you very much, Lois. Yeah, let's now briefly talk about the new technical developments and the digital reporting and the ISSB taxonomy that you might already have heard about. So taxonomy, in general term, the taxonomy is really just a word for classification system, and often the companies will have their own internal taxonomies that essentially help to define key terms across business or functions. You may also have heard the term taxonomy in the context of sustainable finance taxonomy, such as the EU taxonomy, but also a growing number of countries that have developed their own green taxonomies and these are often core components of a broader sustainable finance framework. But this is not what we're talking here when talking about the ISSB taxonomy. As the ones I was mentioning before are just to help to classify different types of economic activity or investment as sustainable. So in comparison, when we talk about the ISSB taxonomy, we're actually referring to something different. It still means the type of classification system, but it refers to one that is used to categorize information within a report. So in this world of the AI and the push for digitalization, you've probably seen a shift or transition away from traditional PDF formats and increasingly towards information on web pages contained with structured data sets, such as databases that are offered by stock exchanges or regulators. So recognizing this is this digital shift, so to speak, the IFRS Foundation has developed the ISSB taxonomy, which is essentially a machine-readable digital tagging system published in April 2024, with the overall intent to help investors analyze sustainability reports. And the taxonomy does this by essentially translating the requirements of S1 and S2 into the standardized data tags, which facilitates digital reporting and makes it easier for investors and data platforms alike to take large data sets like information from entire industry, for example, and bring them all together for analysis. Now, the ISSB taxonomy is not mandatory for compliance with the standards, but rather the taxonomy is designed to support the digital submission of the ISSB disclosures, which comes with a few benefits. So it makes the analysis faster, easier, because the data is structured in the same way across businesses, sectors, and geographies. And also tagging information can help facilitate automated checks for quality and consistency. It can also help improve the report preparation, given that more data collection and management systems are already compatible with digital reporting taxonomies. And finally, the digital text can have a labels and description in different languages, which greatly enhances the accessibility of information across those languages. Right, so that was about the digitalization and the format of the ISSB disclosures. Now we're going into this next section of this module. I talk about efficiency. So we covered so far the location and timing. We wanted to spend a bit of a time talking about efficiency. And we actually added this to training because we often hear from companies that they face a growing reports burden. And what we hope to highlight is that when applying the ISSB standards correctly, there are in fact a number of efficiencies that can be gained to reduce this burden. So what does effective communication actually mean, and what does it look like? So often companies think that if they just pull all the information that they have into a report, they are they've covered everything and everyone will be satisfied. And this is obviously not correct. So remember, and I'll be even against the core conceptual foundation of the IFRS 1, which is a fair presentation, which means that the complete set of sustainability-related financial disclosures under the ISSB should present the information fairly and all sustainability-related risks and opportunities that could reasonably be expected to affect companies' prospects. So it's not about putting everything about sustainability into a report. It's about presenting material information, as we were talking, meaning information that is complete, neutral, and provides an accurate depiction of risks and opportunities that company face. IFRS also requires information to be clear and concise, and the clearest form of disclosure can talk about obviously depend on the nature of information. So this might include, for example, use of tables, graphs, or even diagrams with a text. So in terms of being concise, this really means that companies should avoid unnecessary duplication, use clear language, and avoid boilerplate information. Now let's turn into quality of information, and what does it mean? And traditionally, and the disclosure of sustainability information and financial information has been also a bit different. So there's a difference between sustainability reporting in that regard and financial information. So accountants in the audience probably are very familiar with the rigor that is required when it comes to data collection, oversight, sign-off, and even external assurance that is associated with the preparation and disclosures of general purpose financial reports. So in comparison, the sustainability information has not traditionally, at least, been prepared under such a scrutiny and type of control environment. And because of this, the ASB standards really do focus on elements of quality. For example, through requirements related to providing comparative information from the previous reporting period, except for the first year where this is not required, where there's a relief, and as well as requirements that deal with restatements and the need to restate comparative information or amounts for prior periods disclosed in the case of material error. So again, focusing on quality, companies should also avoid unnecessary duplication, use cross-referencing where relevant, as we discussed earlier. We've discussed also materiality before, and the word ASB standards required to disclose material information and that companies provide connected informations. So including highlighting connection between risks and opportunities, also between the core content areas, and of course, between sustainability information and financial statements. And then last but not least, when aggregating, information should be aggregated if it has a characteristics that allow that, and disaggregated if not. This is really about ensuring material information is not obscured, such that information shouldn't be aggregated if doing so with obscure material information. And we mentioned before cross-referencing. So as you may have noticed, there might appear that there'll be some overlap in the topics covered and the information disclosed across different reports or sections of the reports. So indeed, there's a requirement, and as one states that is out, that the companies should avoid unnecessary duplication. So for example, if a company has the same governance approach for all sustainability areas, then this information would only be disclosed once. And if climate-related risks and opportunities are governed in the same as other sustainability risks and opportunities, this information would be disclosed as a whole once in the report. So as we discussed earlier, cross-referencing is only allowed provided that the other report is available on the same terms and the same time. So again, to illustrate that how that works in the real world, and how that can be disclosed by a company. We'll have another example. Over to you, Lois.
Thank you, Robert. This is just a very quick example about to illustrate cross-referencing, or one approach to cross-referencing. And this is from the steel manufacturing company called ArcelorMittal. And here ArcelorMittal map to the areas of their 2024 reporting outputs those parts that address the content elements and core concepts of the IFRS S1 standard. So you'll see down the left-hand column all of the sorts of words you're now familiar with, governance, business model, risks and opportunities, etc. So these are the IFRS S1 content elements. And then in the second column, they tell us where we can find information about those subjects and principles. So sometimes they're cross-referring within the report. So in business model, they refer within the report. Other times they're referring to one or more reports. So if you look at strategy and resource allocation, you'll see that there's cross-referencing within the report and to the annual report and to the Form 20F, which is a US registration document. So just one way in which cross-referencing can be done. And back to you, Robert.
Yeah, thank you, Lois. We're moving to the next topic area here. It's about the mechanism that support the adoption. And Lois has already touched on the proportionality mechanism. I won't go into detail here. The key point is that S1 and S2 include mechanisms designed to help preparers to get started, recognizing that companies have different levels of maturity and capabilities and also resources in sustainability reporting. So many requirements are applied proportionately. For example, qualitative scenarios analysis is permitted, and the standards use concepts such as reasonable and supportable information available at the reporting date without undue cost of effort, and approaches like commensurate with skills, capabilities, and resources. So the standards also include transition release for the first year of application. This includes the option to report only on the climate related risks and opportunities in the first year. So the so-called climate first approach, before expanding to other sustainability related risks and opportunities in the year 2. And there are other reliefs also related to timing of reporting, comparative information, and scope 3 emissions, as well as the use of the greenhouse gas protocol corporate standards, and the use of value chain emissions data from entities with different reporting cycles. I'm not going to go them into detail. Please refer to the handouts and essentially to the standards themselves to find out more about those opportunities and possibilities offered and included in the standards. So together with sources of guidance, such as the SASB standards, and these reliefs and proportionality mechanisms are intended to support companies in building reporting practices that provide high quality and decision useful information, which is also available and possible for the companies with the limited resources and skills at least at the beginning of the reporting and disclosure journey. And we'll have now another short Zoom poll. So the question is: information disclosed in accordance with the ASB standards should be, and these are different characteristics of the information, decision useful material, misleading, and comparable. I hope that even intuitively you'll be able to answer this question, and I'm not gonna, and I'm sure that, and I see already that you're answering this correctly. So obviously the information should not be misleading. So it should be decision useful material and comparable, and that's A, B, and D. These are the correct answers. So the very much last element we want to talk about today is the statement of compliance and how to get the confidence in the disclosed information, and how to get investors being confident about disclosed information. So a company that complies with all requirements in the ASIS standards, it is required to make the explicit statement of compliance. And it's important to emphasize here that a company can still make a statement of compliance if it has decided to make use of those transition reliefs in the first year, which I was talking before, and also if the company is using any of the proportionality mechanism, the statement of compliance is required and is let's to say allowed. There are also two exceptions when information required by ASB standards could be omitted that would still allow companies to make a statement of compliance. So these are first one is commercially sensitive information, and the second one is when law or regulation prohibits disclosures. So I'm not going again to go into the details about this and what that entails. Again, please refer to the handouts, and by explaining it, what specifically what circumstances and what conditions, and these two exceptions can be applied, and statement of compliance can be still concluded. Just here, importantly, companies that are beginning to phase in the ISSB standards voluntarily, and then therefore are partially applying the standards, these companies would not be able to make the explicit statement of compliance. So instead, what we typically see companies disclose is an explanation of where they are on the disclosure journey, so to speak, and to outline what measures they are taking to enable future compliance with the requirements. And you can find more about this by following the link here on the slide and in your handout, which will take you to the guide on the IFRS Foundation published guideline document in 2024 on the topic of voluntarily applying the ISSB standards. So very last things to remember to wrap up this unit. We have highlighted a few things few things to remember about disclosing sustainability information effectively, efficiently, and in a way that builds confidence. So first of all, ensure that information follows the requirement for presentation, and this is stated out in the conceptual foundations. So this includes the fundamental characteristics of decision useful information, that is, say, information is useful to the decision-making process when the information is relevant, material, and when it faithfully represents what it says. There are also enhancing characteristics of the information that to say information should be comparable, verifiable, timely, and understandable. Another key element is to ensure that investors can understand the connection between the information disclosed, as we said already a couple of times. So the connection between the risks and opportunities, between the different disclosure areas, and of course, between the financial statements and sustainability disclosures. And finally, very important, need to ensure that the ISB disclosures should be for the same reporting entity and cover the same reporting period as the financial statements. So disclosure should also be published at the same time as the financial statements and should include the explicit statement of compliance. And there was additional slide in your slide handout for this section that includes some of other reminders. But this is all from me. Thank you. Over to you, Fiona, for the summary of the module.
Great, thanks so much for that, Robert. So that brings us to the end of Module 4. So well done, everyone. We're into our final 10 minutes of the workshop now. So great job sticking with us this far. So just to recap then what we covered in our last module here, communicate. Firstly, we discussed where to report information. And what was important here was the audience, or who you're reporting to. So make sure to be clear from the start who the primary users of information is, and that's going to help you to then ensure that the information is right for their needs. And when we're talking about the ISSB standards, we're talking about financial stakeholders and investors predominantly here. Then we discussed efficiency. And I think the key takeaway here is that less is more. So the objective isn't to overload investors with information, because actually that could be harmful and obscure what they need to know. So this is where the ISSB standards are really designed, of course, to focus on that concise, clear, and material information. So really trying to keep that emphasis in mind, and being strict with ourselves if we can about what meets that threshold is a key objective. And then finally, we discussed report user confidence, and especially in the current climate where there are greenwashing accusations and legal challenges to public statements, you do want to ensure that your data is not only accurate, but that you're presenting it in a way that builds confidence among report users. And so that's where the disclosure plan that we've been discussing throughout our training today can help you, because if you do this well, it gives you a clear and documented process for reporting the data that investors want to see. Okay, so if we go back into our last activity now, we'll just do this quite quickly, but we talked there about how to structure our reporting, how to make it easy to navigate, and how to report clearly. So let's have a little reflection together on what you think the best techniques you either use or that you observe from disclosures are to support information to be presented in an integrated way and in a concise way, which we know is the real challenge here because there's a lot to cover. So as much as we can, we want to help users navigate our reports so that we don't need to repeat ourselves in what we're saying. So I see we've got a couple of responses. Let's see if anyone else has any thoughts before we close off the session. Great. Thank you. So someone's mentioned clear headings, tables of contents, page numbers. Great. Lots of similar responses. Maybe AI's helped us out there, or maybe just someone posted it a few times, not sure. But they're all good suggestions using charts and tables. Someone's mentioned Power BI. Maybe if you make things digital and interactive, yes. Maybe using that to inform what you disclose. Summary tables, categorizing invest information and stakeholder information. Yeah, that could be interesting. Using indexing, using a fixed standard framework, so being clear on what you're aligning to here, numbering things in a universal way, definitely, color coding, visuals, lots of great ideas. Thanks, everyone. I think good things to take forward and think about here to keep in mind for our reports. So the last question we have for you in Menti is just to revisit that comfort level that we assessed at the start of the session. So if you remember, we talked about these 3 different areas that we wanted to help move forward with. And I think we were somewhere in around the 2.5 out of 5 on the scale of how comfortable we felt with these topics. So it'd be great if you could just let us know now how you're feeling. Hopefully a little bit better, but it's always good for us to see how well we're doing in our training session to help you on these topics. So do let us know honestly how you think you are feeling currently. But it looks like from you who've responded so far, we're kind of in the threes now. So we've moved up from the 2 to the 3. So good to see some improvement, but we know, of course, there's a lot to cover here. So we're going to wrap up now with a few takeaways on resources that you may be able to use to support you to continue this learning journey. So one of those resources will be the homework assignment. So just as a quick reminder, this is optional. It's not mandatory to complete it, but you can download it from the page that we've shared for today's workshop. At the bottom of the page, you'll find a link. This homework can help you to develop that disclosure plan and put into action what we talked about today. So be sure to check that out if you're interested to continue to build on this from today's training. I'll also pass back to Robert now, who's just going to highlight a few key resources from the IFRS perspective as well.
Yes, thank you, Fiona. Yeah, really quickly, this is also, please remember to use our Knowledge Hub. You probably know it already, but we introduced a new feature in our Knowledge Hub where there is a new section there under resources menu. You will see the link to IFRS Foundation resources, which is a subsection of our Knowledge Hub where you can find all key IFRS educational materials listed there by topics. We heard before that our educational resources sometimes are not super clearly available on our website and not so easy to navigate and find them. And we hope that with this new feature and subsection, this is easier and you can browse through them in a more inviting way. The other one element which I want to mention here, we have e-learning. So as a maybe extension of this introductory training with UNSSC, you'll be also willing to get further and explore our e-learning for modules, which covers all the elements we talked about today, but going sometimes with even more details, more examples. So please do explore it. This is all free, available on our website. And there's one more element, or actually 3 more other elements we should briefly mention here. We also offer FSA credential. So this is a professional certification you can subscribe to. And this is very much, let's say, the most advanced way to get the necessary skills and qualifications to be really an expert in sustainability reporting. So please do explore it. And the other educational platforms we'd like you to consider is IFRS Sustainability Alliance, and also licensing if that's relevant for your organization. So please have a look. There are links on this in this presentation, and please find them. More information. If you have any questions, please get in touch with us and we'll be happy to help you. Over to you, Fiona.
Great, thanks for that, Robert. And then just to close things off, so I'll just highlight from the IFC side as well. You remember Lopa highlighted to us at the beginning of the session, the Beyond the Balance Sheet program. This is another great resource that you can refer to, which brings together a broad set of resources targeted at emerging economies, focused on sustainability, governance, and disclosure. So you can find the links on this slide here to access a number of the key resources, including the e-learning course that the IFC have developed on sustainability reporting, and the website as well to contact the IFC team if you'd like to follow up about those advisory services that Lopa mentioned. As a quick reminder from the SSE side, we also have that toolkit that we've shared with you already in the training. But we're nearly done with the training, and I know we have one last very important thing to talk to you about, which is your completion certificates. So to get your certificate of participation for taking part today, you'll need to fill out the feedback survey, which we're just about to share in the chat with you. Thanks, Lois. So if you follow that link in the chat message there, fill out that survey, we'll send you a certificate to the address that you complete the survey with, the email address. If you miss this link now, it's available currently, but we'll also send it in an email, which you'll receive from Zoom tomorrow, this time tomorrow. So give us about a week once you've filled out that survey to receive your certificate. Make sure to check your spam folders if you don't get your certificate. And otherwise, you can contact us if you do have any issues. But thank you again for your participation, and we look forward to hearing your feedback as well. Lastly, just to say a few final words of appreciation, firstly to the SSE official supporters, a group of stock exchanges and wider financial market participants who are helping to support our work on an ongoing basis. If you're not a supporter and you'd like to know more about this programme, feel free to reach out to the SSE at the contact details we include in the presentation. We'd also like, of course, to thank our hosts today at the Colombo Stock Exchange for being with us and supporting to bring us all together in today's training workshop. We'd also like to thank finally our partners at the IFC and IFRS Foundation, and in particular Bella and Robert, for joining us today and sharing their expertise in the training workshop. And lastly, of course, a big thank you to all of you for taking part today and for joining us. Wishing you a great rest of your day, and we'll hope to see you again at a future workshop. So many thanks all, and we'll close the session off there.